Good morning and happy Monday. It's 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Diane King-Hall. Here are three things you need to know to get your morning started. Investors largely brushing off a failed coup in Russia, but attention still very much on Europe on the last trading week of June. The leader of an armed revolt against Vladimir Putin's government ordered his forces to turn back. Despite this, it's still being labeled as the biggest challenge to Putin's regime and the Russian elite in decades. Crude oil edging a bit higher as traders eye more political uncertainty in the weeks to come. The biggest reaction came in the European natural gas market, an area that is sensitive to any conflict in the region. Stocks are looking for direction this morning as the seemingly unstoppable equity rally comes off the boil. Morgan Stanley's Mike Wilson sees a wall of worry for stocks denting sentiment. JP Morgan's Marko Kolanovic warns of unknown unknowns hurting equities. That downbeat tone doesn't stop there. Bank of America strategists say U.S. stocks face more downside than upside over the next 2 months. They suggest that banks have bad recession vibes. We'll get a sense of how financials are doing with this week's Fed stress test results. And the China slowdown story isn't getting any better. Fresh data shows domestic travel spending during the recent holiday season there was lackluster, slipping below pre-pandemic levels. The pain does not stop there, though. Estimates for June car sales are weak, and new home sales figures are underperforming previous years. The read across for investors, more downside perhaps for the nation's equities. Stocks on the Shanghai Composite have now dipped beneath the critical 200-day moving average that is seen as at a special support level.
Now, an unprecedented crisis playing out over the weekend. Russian President Vladimir Putin faced a dramatic challenge to his rule after an armed rebellion led by mercenary chief Yevgeny Prigozhin led his troops out of Ukraine and into the south of Moscow. The group says it was not a military coup. Now, despite the group abruptly turning back, this would be the Wagner Group, it's still being labeled as one of the biggest challenges to Putin's regime in decades. Stock futures trading a little lower, kind of narrow range, as investors remain concerned over what the short-lived rebellion means for markets. Trying to help us read the tea leaves here, Yahoo Finance's Rick Newman joins us now. Hey, Rick.
Hey, guys. I think the biggest question for markets right now is this actually a short-lived rebellion? In other words, is it over, or is this just the beginning of something bigger that's likely to happen? Obviously, we don't know, but the sort of imponderables here are quite interesting. So is Vladimir Putin's leadership falling apart? If that were to happen, it would have major implications, not just for energy markets. Russia, of course, major exporter of oil and gas, but also wheat. Russia's a huge exporter of wheat. Also lots of commodities, minerals, nickel, cobalt, things like that. So those are all the things that are at stake if there is some, potential change of power in Russia. And then you also have to ask the question, what effect is any of this likely to have on the war in Ukraine itself? I mean, if this would hasten the end of the war and benefit Ukraine, that would obviously be bullish for global markets, but it could be quite a mess getting there. So just a mind-blowing series of developments in Russia, and many analysts think it's not close to being over yet.
Not close to being over. I mean, do we have any sense of what happens in the very near term here, Rick? I mean, we know that the head of the Wagner Group has gone to Belarus, or at least that was part of the agreement, but we're actually not sure that he's gone there. But do we know what to watch for this week, for example?
Yeah, I mean, the sort of personal drama regarding this guy, Yevgeny Prigozhin, is fascinating. And many people think he will not be alive at the end of the year. He's going to fall out of a window or be poisoned or something like that. But the broader question is about Putin's hold on power. Many analysts are expecting some kind of purge among people who may have sort of thrown in with Prigozhin or not sufficiently stood up on Putin's behalf. There's a question of the two guys who are basically running the war and doing a terrible job. They have not been seen. So there are all these questions about who is actually in charge in Russia, and I think also importantly, who is running the war. These are the kinds of things we're trying to figure out, and whether there will be some changes in this cast of unruly characters, or things will somehow get back to normal, is one of the things everybody's trying to figure out right now.
Yes, most definitely. All right, Rick, thanks a lot. Appreciate it.
Bye, guys.
Questions continue to linger over how markets will react to such geopolitical risks. For more on the Russia-Ukraine crisis and more broadly risks for markets, we're joined by Tony Dwyer, Canaccord Genuity Chief Market Strategist. Tony, this kind of reminds me of maybe summer surprises we've gotten in the past, right? I think about the Brexit vote. I think about the downgrade of U.S. debt, for example, as things that happened in the summer months and kind of shook things up. This didn't feel like that was it, right? But I wonder kind of what's on your unexpected risk radar right now.
Julie, I think what's on the unexpected risk radar is that this is a normal economic slowdown driven by credit contraction that happens from an inversion of the yield curve, which happens because the Fed increases interest rates to a level that suggests it. And I think, the Russians, the TVs and all the shows are filled with people that have all of a sudden become a Russian expert. I'm not going to be one of them. I didn't see it coming. I have no idea what it means. What I do know is that it's if companies and lenders will not lend money to lose money, and with all the yield curves inverted, that ultimately should have some kind of impact on economic growth and therefore the markets.
But Tony, the conflict, of course, is ongoing between Ukraine and Russia. So where does that stand in terms of what we should be monitoring when it comes to different asset classes? Like, should we be paying more attention to commodities in light of the ongoing conflict?
Well, Diane, it's not having an impact that I can tell. So it's not like something happens in Ukraine and all of a sudden the markets react to it. Right now, I hate to say such a tragedy is on the back burner, but that's not what is driving the investment landscape. So we could write about it, we could talk about it, but ultimately it comes down to the action. And I don't really sense that there's any major action in the backdrop because of what's taking place in Ukraine and Russia. So that leaves us again, going back to the, what if the difference this time is this just an old school recession developing that's based on not a credit catastrophe, but just a shrinking of credit? And ultimately, that leaves you in a market that is elevated on the hopes for a soft landing that it just does. The data that I'm looking at just doesn't seem to suggest.
Well, I was looking at the latest MLive survey from Bloomberg, and they surveyed people as to what the S&P 500 is going to be at the end of the year. I think it was something like 4,200. So not seeing the rally continue. Where are you on that front?
Well, Julie, I think, we've done this for a while. I mean, what market are we talking about? Are we talking about the top 8 stocks? Or are we talking about everything else? Because if you're looking at everything else, it's already had a pretty tough start to the year. When you think about the Dow Jones Industrial Average is up 1.75%, and that cash is outperforming actually through the first half of the year, the annualized return of a lot of the major indices outside of the mega cap weighted indices. It's been a more uncertain environment for the average stock than it has been for those mega cap stocks that are really driving the performance of the indices.
All right, Tony, stay with us. We're going to dig a little deeper in domestic. So who's the boss, the Fed or the bull market? In today's morning brief, our Brian Sozzi says that investors should fight the Fed at their own risk. Given the Fed's continued hawkish stance since the June meeting, the possibility of further rate hikes is strong. So should the bulls rein it in? Seems like they have a little bit now. The market, while down the last few days, has remained resilient in the face of negative surprises like the regional bank crisis, I should say. Goldman Sachs strategist David Kostin wrote in a weekend note that stocks with quality attributes should outperform even with tighter monetary policy. We have Brian Sozzi with us for more on all this. We're also bringing back in Tony Dwyer, Canaccord Genuity Chief Market Strategist. So fight the Fed at your own risk?
Yeah, fight the Fed, get clubbed over the head. And I think Tony was really on point. Will bring to light this economic slowdown we are in fact experiencing. So you take that economic slowdown and you have a Fed just about a week and a half ago, 2 weeks ago, telling investors, a pause does not mean we're done raising rates. And as you go around Wall Street, you have a lot of folks, I think, now worried about 2 more rate hikes this year, not 1, 2. And that is a big change in sentiment and market expectations just compared to a month ago that sent all these AI stocks to records, set NVIDIA stock to over $1 trillion market cap. So there's been a change in sentiment. And I think the market is still trying to adjust to what the Fed may do in the back half of the year. And you can fight it at your own risk. But a lot of folks I'm not talking to in the street are now trying to get a little more defensive, position clients a little more defensively, dividend payers, safe balance sheet type companies. So rotating out of some of those riskier areas into more safe haven plays.
I mean, Tony, it feels to me not like the Fed changed its message, but that the market finally just started listening to what the Fed was saying. I mean, all these people pricing in a hike before the end of the year, that was not the message that the Fed was ever putting out there.
Yeah, to Brian's point, a lot of folks are now starting to talk about actually taking place in the average stock. The thing that blows me away, Julie, is that people keep referring to what the market is saying, even though the market has been dead wrong on what the Fed is going to do over the course of the last year. Like I look back at the middle part of last year, and the Fed funds future peak rate was expected to be 3.25%. So the idea that we're going to look at what the market's expecting and somehow extrapolate what the Fed's going to do kind of is bananas. So to me, when I look at what are the market, the optimism in the market is surrounding this rolling recession or soft landing environment. So what I did is I looked back at the two prior soft landings that we've had, which were 1966 and 1995. And it's not like it just came from magic. Those soft landings were generated because there was an amazingly fast drop in interest rates and short-term interest rates that created a steepness in the yield curve that increased the outlook for money. In other words, by making it more profitable for institutions to be lending. We're not, obvious to Brian's point, we're not seeing that. We've seen this elevated level of short-term interest rates. So the catalyst for a real market rally or a soft landing comes from short-term interest rates because it improves the outlook for money. And that is obviously not present today. We're 126 basis points on short-term interest rates higher than we were from the October low of last year. And that's just so different than what happened in any prior soft landing or soft landing market recovery.
Tony, it feels like the market is it's hanging tough because the fourth quarter by this year, you might see a reacceleration in earnings growth. S&P 500 earnings maybe grow between 8 and 9%. But if we do in fact get two more rate hikes, is this just a market that is just clinging to too much hope about corporate earnings power?
Brian, I really go back to, there has been a little bit of broadening, but what market are we talking about? You've got more than half of the S&P sectors that are down for the year. The Dow Jones Industrial Average is only up 1.75%. The Russell 2000 small and mid cap indices are up small single digits. So it's not been a robust year. And I think that's the challenge for folks like us to talk about is we're gauged by the S&P 500. That's the major market that, okay, is it a good year or a bad year? But that's really that based on those mega cap tech stocks, which dominate the Nasdaq Composite and NDX as well. Those are really the ones that are up. So you've got this extraordinary movement in those stocks. And, the debate becomes, will that mean that the broad market plays catch up? Again, Brian, I go back to what happens with short-term interest rates. Like I'm typically kind of known as the perma bull and the guy that's the most optimistic. And it's no fun being cautious, but there's a reason for that. You should be a perma bull when the money's widely available and growing because it's a leveraged system. And to me, I've always been really bearish when the money is shrinking and the outlook for money is not improving, because that's what creates that ultimate earnings decline, which ultimately I believe is going to come.
Tony, you don't sound like a perma bull right now. Look, there's a factor of market psychology that comes into play, and we've recently seen this kind of FOMO situation happening in terms of market action and investors getting bullish and following the trends. How can you say not you're like getting in front of a moving train? It feels like.
Well, you don't have to bet against it, Diane. There's this great idea that if you're not long, that must mean you're short. How about you get? So here's the way that I think about this in the broad market, which answers all the questions, right? I'm not betting on the downside. We're already a year and a half into this, and the average stock is already down pretty significantly from a 52-week high. But if you use my $210 estimate, which is well above some of the more bearish estimates, but below the current consensus, if you use my $210 earnings estimate for this year, and for the viewers, if you use the earnings yield, which is the inverse of the PE, so it's the EP, that gets you an earnings yield based on current prices of about 4.75%. As I look over at my screen, I got a 6-month T-bill at 5.4%. So I got a riskless rate of return for 6 months of 5.4%. with a risk rate of return of 4.75%. It doesn't mean you have to bet on the downside, but in that scenario, I don't exactly see why you want to bet on even more risk after you've already had that FOMO rally.
What unlocks the upside for stocks?
One thing, Julie, and that's a significant drop in short-term interest rates that re-steepens the yield curve and incentivizes the outlook for money. Remember that we typically see a bear market low in a recession. And it doesn't make sense to a lot of individual investors. Like, how could you bet on a recovery in the middle of a recession when you know that things are negative? And the answer is because short-term interest rates have come down enough that it is really incentivizing lending institutions to provide more money. That or for households to refinance or corporations to take out more debt. I mean, high yield debt is actually up to 9% again. So I get it. Credit spreads are a little bit narrower and they don't suggest a recession. Tell that to a company that's raising money in the high yield market. Mortgage rates remain high. All those things that are tied to short-term interest rates are still suggesting that you shouldn't have this big boom in economic activity. So it's a very long-winded answer to short-term interest rates must come down, and I will change my tune at that point.
Okay, we like that. So much so we want you to stay with us, Tony Dwyer and Brian Sozzi as well. Thank you for our morning brief, but all of us, let's stay together. We want to keep talking about the banking sector in particular. So shares of PacWest Bancorp on the rise this morning, jumping more than 7% on news. The regional bank sold a $3.5 billion loan portfolio to Ares Capital. PacWest says the deal will improve its liquidity as the regional lender moves to focus more on relationship-based community banking. This as the Fed is expected to release results from its annual banking stress test Wednesday, an assessment of banks' ability to withstand crisis. The results come just months after the collapse of several regional lenders and amid chatter of a possible recession on the horizon. Let's bring back in Tony Dwyer, Canaccord Genuity, a chief market strategist. So let's talk about these stress tests. Of course, this latest round, kind of the formula was created before the regional banking crisis. Do you think it's enough to address where the banks stand right now?
Well, Diana, this was never a bank crisis. Right, that it was a regional. There's some regional banks that definitely were in crisis, obviously, but the major banks that are subject to these stress tests are well capitalized. So it wasn't about whether the banks were going to fail. That was the last cycle. To me, this is all about is the regional bank issues going to increase or decrease the willingness of banks to lend? We were in a bank lending standards going into at the most recent survey, which was January, prior to the regional bank issues, were already in a level that would suggest a recession. So did the Silicon Valley Bank issues, the stress tests, the fears of increased capital needs, is that going to make them want to lend more or less money? And I would think it's going to make them want to lend less money, which again goes back to my prior points of what really drives the market from here is economic fear.
So it sounds like we should be paying more attention to those regional bank surveys, right? Or those quarterly bank surveys, I should say, about loan officers than we should necessarily to the stress tests.
Yeah, Julie, it's really listening to the bank management conference calls. Right? I'm not a bank analyst, so similar to the Russia comment, I'm not going to pretend to be one on TV. What I do know is that it's a human nature call. If they're telling you, if you're fearful that you're going to lose money, they're going to increase your capital needs from a regulatory perspective, and you're going to get all this scrutiny about what you have on your balance sheet. That if I'm the head of a bank, I'm not sitting there saying, okay, let's go take more risky loans, especially because I have an inversion of the yield curve. So ultimately, that's why, Julie, you asked the exact right question. What changes the tune? And all of it changes with a short-term interest rate environment where you see a dramatic drop in rates because that fixes a lot of the problems making money more available.
But sorry, if I can just jump in here. It doesn't sound like that's going to happen, though, anytime soon, the drop in short-term interest rates.
Well, now that everybody's priced it out, there were 4 rate cuts priced into the market about a month ago, which tells you how smart the market is on the Fed funds futures. But that can change really quickly. You're going to have a combination of a pretty dramatic reduction in inflation and a rise in unemployment, and that will create a Fed. I'll tell you the language that I think will end up happening. They've been focused on this. We've got to get to 2%, or until we see the whites of the eyes at 2%. Well, how about if you're trending lower on the core inflation rate while unemployment is going up? I could see the language of the Fed dropping rates because inflation's trending properly, and we now have an increase in employment that takes the wage pressures off it. And you could see how the Fed could surround potential rate cuts either later this year or into early next year. Things happen quickly. When you look at the unemployment rate or other economic indicators, they go bad quickly. It doesn't look like it, doesn't feel like it, but that's what can happen.
Tony, the Fed talked a lot about its failures, if you will, with regard to the regional banking, for lack of a better word, crisis. And we know that the stress test came about because of the financial crisis, 07, 08, 09. Do you expect further regulation to come as a result of kind of this wave of what we've seen within the banking sector?
I would bet so. How that looks will depend upon the makeup of Congress as we go through the election, because it typically comes well after the fact, because you have to have a lot of subcommittees interview and really get all the data in place so they can make a decision. But that's already I don't want to say too late. It's already going to be priced into the market. Think about, I was around during the savings and loan crisis in the late 1980s, early 1990s, where you set up the Resolution Trust Corporation that increased regulation in that framework. Then of course, you had the dot-com bust. Then you had the global financial crisis. So Diane, every major economic-based market decline typically surrounds the bank because the Fed inverts the curve. Like, think about, Jerome Powell talked, and I thought he gave a great analogy. He said, they were on a highway. They were going really fast. Okay, they're getting toward their destination. They're going to slow down. Well, what if they get past the destination and they have to slam on the brakes and do a skidding turn, right? That typically is what happens, which creates the issues that you have in some segment of finance that gets regulated after the fact.
Tony, by the way, there's no way you could have been around during the savings and loan crisis. You were still in elementary school at that point.
Yeah, I was in middle school. Yeah, I'm a millennial, can't you tell?
Just one more quick question when it comes to how all of this relates to the financials. I know you're mostly a macro guy, but how are you positioned in the financials right now? Is that neutral rating? Is it something you want to avoid?
So our call, Julie, has been, I call it being light and tight. We're 18 months into this, 16 months into this. I don't want to be really negative. I want to be able to take advantage of weakness. So I would be a slight underweight in the financials. They're not acting well. They haven't. The financials are a great example. You're going to get negative on the financials now? Like, they haven't rallied. They're down. The relative performance is horrible. So it's a place that once you get into this recessionary where it becomes clear that you're going into a recession, I want to look to take advantage of them. So I don't want to bet on the downside. I want to stand ready to take advantage of it. And that would include the financials.
All right, we're going to get more on this light and tight philosophy in just a minute. Stay with us, Tony. We're going to be right back with the opening bell. And coming up, the last month has been good to travel stocks with the likes of Delta, Norwegian Cruise Lines, and Carnival on the up ahead of the summer season. But are the cruise operators still ticking along? We'll take a closer look next. Will this be a summer for stocks to sizzle or slump with further Fed tightening on the horizon? Investors are on edge. Our next guest says, as we just heard, we should keep it light and tight this summer. We're bringing back in Tony Dwyer, Canaccord Genuity Chief Market Strategist. You just talked a little bit about, in your mind, what it means to be light and tight here in this difficult environment. Are there particular areas where you think people should be really ready to sort of deploy cash if something happens in the market?
Well, light and tight means light in exposure, meaning a little bit extra cash, and tight to the benchmark. Remember, we advise institutions in the U.S., many of them long only. So how you are relative to the benchmark is a major influence. And we would rather be tight to the benchmark versus excessively defensive, even though we have a recession call. So, Julie, we would suggest being right now a little bit more defensive in the healthcare, interest-sensitive areas, as well as, like I said, a little bit more fixed income exposure. But ultimately, you've got to have that short-term interest rate market come down. And that's when we're going to look to add into the cyclicals or those early cycle names when it becomes evident that there's a recession or a recession unfolding.
Tony, previously you've said you expect the S&P 500 to test its October lows by midsummer. Do you still have that expectation?
Well, that would be a hell of a drop from here in the next week. So no. Ultimately, I think there's going to be some more meaningful weakness. Whether we break the October lows, I think, is in question. If you go anywhere near it, it's a significant enough drop, I think, to change the sentiment. Again, if it's associated, whatever the drop is, Diane, associated with a short-term interest rate environment, that's really going to be the catalyst. It's not where the S&P is. Remember, as I said before, the S&P right now is being driven by a lot of 10 mega cap stocks, which comprise over 32% of the market capitalization of the index, higher than at any time since the early 1970s. So ultimately, it's not really where the S&P call is, it's where the rest of the market is, which has remained weak. A little bit more weakness coupled with a short-term interest rate drop is really going to be the catalyst to get us in the game.
Tony, I'm amazed that we've gotten to this point without talking about tech. But if you're sort of tight to the benchmarks, that effectively means that you have a decent sized weighting in tech because of their weighting in the benchmark. Does that imply here you don't expect any maybe big outsized moves from here when it comes to tech?
I would have been light, underweight tech, and especially mega cap tech. And I think, again, Julie, I think that's where you have to look at the differentiation between the biggest stocks and the rest of the market. Like a lot of those software names and other areas of tech have not done anywhere near as well as the market cap weighted sector index. So again, I think it comes down to where are you exposed in tech, and I leave that up to the sector strategists and experts. But at this point, I would still be underweight that area a little bit. But think about it, a lot. It's not just tech, it's consumer discretionary because you've got Amazon. It's communication services because you've got Meta and Alphabet. So we still talk about it like it's tech, but there's three sectors that are up more than 20% year to date when everything else is either flat or down.
And Tony, how do you play the balance of the year? You use your phrase, keeping it light and tight. Is that through the balance of the year, or is that just a summer play? There's often the phrase that the best defense is a good offense. So what's the offensive plan through the rest of the year?
Again, the offensive plan, Diana, is simply to be guided by short-term interest rates. If they start to come down dramatically, that's going to be an underpinning for the outlook for money, which will get us bullish. So it shouldn't be, guys, it shouldn't be based on a calendar date, an election year, or a summer, a fall, a year. It is based on the tactical backdrop of how overbought or oversold we are on an intermediate term basis, coupled with the outlook for money, which is driven by short-term interest rates. So I'd love to tell you this is the entire plan for the rest of the year. If it unfolds in the next week, that's going to be the catalyst. And that's where, again, our strategy is to stand ready to take advantage of weakness versus betting on it when we're this far into it and the average stock simply hasn't performed anywhere near like the indices.
All right, we will have to put a pin in our conversation. Always great insight. Tony Dwyer, Canaccord Genuity, Chief Market Strategist. We appreciate you.
Great to be with you, Julie. Bye, Diane.
Bye. All right, we just had the opening bell on Wall Street. Markets trading narrow range as we enter this final week of the quarter. Dow just above the flat line, barely up just 4. S&P's off by 3. Nasdaq under just a little bit of pressure. I mean, we're talking a little over 0.1%, down 22. Let's get right over to Julie at the Wi-Fi Interactive for more.
Yeah, with this narrow range, I'm thinking more about year-to-date moves and what we've been seeing here as we get to the end of the second quarter. So you see here, looking at the sector map for today, we've got healthcare and consumer discretionary that are down. We've got energy and materials that are up, but again, not big moves on the sector level either. So I wanted to switch it to a year-to-date here. I know I'm a little ahead of it, right? We don't have the last day until later in the week of the quarter and the month, but nonetheless, still fun to look at how we are tracking. So energy, the worst performer on the year, of course, after seeing big gains last year, off by 11%. We've got tech, unsurprisingly, in the driver's seat here, up by 35.5%, followed by communication services. As Tony was just pointing out, right, it's not just about the XLK, the tech index, the tech sector index. You have to look at communication services, which includes things like Meta, right? And you have to look at the XLY, Amazon in that consumer discretionary group as well. So those are the ones that have been leading the most year to date. So that's what I'm watching. And then switch on over to the Nasdaq as well, and keeping on that year to date, if we can. NVIDIA, as we've talked about, up 190% this year. So that's what the heat map looks like. Not much red on the Nasdaq 100 even for the year to date as we've seen these big gains in technology. So let's get back on over to the intraday look here. And again, not seeing much movement here. We do see shares of Alphabet down a little bit more than 1%, 1.25%. Got hit by a downgrade over UBS today, which we're going to talk more about in just a moment. But otherwise, not seeing a lot of significant movement. And then the other place I want to look today is in crypto, because we continue to see movement on the crypto front. Although Bitcoin today, not much changed. It is still holding right around 30,000 here. And that has been a key level. We are also going to talk much more about that and some of the crypto fallout as we head throughout the show, Diane.
All right, well, let's talk about some movers we're watching. One of them, Carnival Cruise, under some pressure after reporting its second quarter results just before the opening bell. Now, the company reported a loss of 31 cents a share. It was better than the company's initial guidance. The company saw a record revenue of $4.9 billion. That's due to continued acceleration in demand. Still, the stock is under some pressure this morning, as investors do an initial reaction to its results. I mean, look, the stock had been up coming into this, especially with demand coming back to the cruises and them being over 100% subscribed. But I do wonder if some of this play is about, both a combination of taking some profits and also just a hit on travel that may come in the aftermath of the tragic Titanic submersible, and maybe some people will want to be pulling back on just any kind of shore excursions and whatnot.
Maybe so. I mean, I'm looking through this statement trying to figure out what exactly could be responsible for the drop here. The company, as you said, is raising its forecast for revenue in the second half of the year. They also said that they're going to be getting an interest expense benefit from deleveraging that's going to bring $275 million to the bottom line for the year. That would seem to be good news. I don't know what analysts were expecting for that particular number. He talks about, Josh Weinstein, that is the CEO, talking about bookings and customer deposits hitting all-time highs. So still going through here to figure out what's going on. Hopefully we can get some analyst commentary here to also help clear up why the shares are
I mean, it is
underperforming.
a head scratcher. The only thing I can think is just maybe the potential impact to any kind of excursions near water and whatnot. You know, some people may be squeamish after that. We'll see again what the analysts
But you
say.
would think the stock would have already fallen if that was the case, rather than falling when they
on the
actually
day
report
of
their earnings.
We'll see.
I don't know.
See. It'll be one to watch, certainly,
will.
throughout the day. On the flip side, we've got Lucid shares surging after striking a deal with luxury automaker Aston Martin. That stock rallying 9%. Now, the EV company will provide Aston Martin with battery components and tech for its upcoming electric vehicle line, and Lucid will become a 3.7% shareholder in Aston Martin. Not much of a coincidence. The two car companies have a common shareholder in Saudi Arabia's Public Investment Fund, or PIF. So again, that stock rallying 9% on this deal news. We got a little bit of deal news on Merger Monday.
Yeah. I mean, this isn't quite, it's investment news, I guess. There's Aston Martin shares, which are also rallying. And both of these companies have been challenged, right? Aston Martin has been sort of trying to remake itself. Lucid, which had initially seen some strong demand, had seen a little bit of flagging, seemingly, for demand for its vehicles more recently. So both of them, you could argue, sort of needed this news and this infusion and this partnership. So it looks like it's as much a relief rally as anything else on a little bit of a positive catalyst for both of them.
And of course, Aston Martin planning to have its electric fleet by 2026, so they needed this deal.
Yeah, they're also extending their agreement with Mercedes-Benz that was already in existence, but it's now extending that partnership. Yeah. All right, let's talk about another mover, Pfizer. It's sliding today as the company announces it's dropping the development of its Ozempic competitor. The pharma giant's answer to the obesity drug craze excited investors as it offered a pill over the current injectables, but news that lab results showed possible liver injury has supporters pulling back. Joining us now with the update on this, Yahoo Finance reporter Anjali Kamlani. This area is so hot, so it does feel like a setback for Pfizer.
Well, it actually is just an incremental setback. So we've had analysts talking about it as a full or just incremental, basically because Pfizer does have another candidate in the pipeline. They had told us earlier in the year that they were testing two products out. One of them, which is a once daily pill, which to your point does change the game for this space. They are scrapping that one right now, working on modifying the formula for it. Meanwhile, another option that they had in the pipeline, which is a twice daily oral, is going to move forward. Now, a little bit on that incremental setback, they haven't fully figured out the dosage of that. Does require a little bit more testing in clinical trials. So that's kind of where the news comes from today. Less of a full-on setback. They're still sort of in the race with that pipeline, but it does change their timeline in competition with others. We do know that, for example, JPM analysts said today that this represents a clear setback to the program, with that once daily expected to be the more competitive one of the two assets. Again, to that point about the Eli Lilly drug. Now, let's take a look at what this race really looks like. We know about the injectables. We know that those are dominating the market right now, as some of those have already gotten approval to treat obesity specifically. But we also know that a majority of these are actually type 2 diabetes drugs. And Lilly has its own oral one also in progress. We just saw phase 2, mid-stage phase 2 results positive on that note. So really good competition for Pfizer still on that front. And meanwhile, we know oral is sort of the goal for these drugs now. So that's sort of where the race is turning into. Pfizer still well placed for that, but of course a little bit of a hiccup here as it changes which option analysts and those watching the space thought the company would be moving forward with because of that indication of liver damage. So we'll just have to wait and see if they do also reformulate it. They're working on a once daily version of that, and if they get that closer to the finish line sooner.
So, Anj, of course, everyone watching this space because, people want a magic pill versus the injectables. So the competitive leader now, would it be Eli Lilly, and what does the timeline look like?
It is a little bit ahead in the sense that they're both in the phase 2 phase of trials. But Eli Lilly does have more insight, so it could be looking add its oral version getting closer. They are also waiting for that approval of Mounjaro for obesity. So it's important to remember that some of these drugs are already on the market. They're just indicated for type 2 diabetes alone. And so those are the only patients that get access to it for the weight loss benefit. Now, these drugs are also looking to be approved for the labels to indicate for obesity, even though they're being used sometimes for that right now. So the market itself is already there. It's just a matter of improving these formulations. And GLP-1s, which is the class of drugs, has been around for some time, as early as the early 2010s. So we're not looking at new drugs per se, but just better formulations of them.
Anjali, thanks so much. Anjali Kamlani. Coming up, AI headwinds. There's a rare downgrade for Google parent Alphabet. We'll tell you who and exactly what's behind it next.
Or something. I don't know.
On the table.
We're keeping a watch on oil prices today after OPEC said it expects global oil demand to rise to 110 million barrels per day by 2045. Oil trading a little bit higher at the moment. Yahoo Finance's Jared Blickery joins us now from the floor of the New York Stock Exchange with some insight on that and more. Professor Jared, take it away.
All right, Diane. Well, I think the really interesting news that's really catching traders' attention is what's happening in Russia, and that's with the potential coup on Vladimir Putin. Now, I'm taking a look at the Wi-Fi Interactive. The price action since the open yesterday and Sunday evening, really not that volatile. If you go back to the beginning of the Russia-Ukraine conflict at the beginning of 2022, and I'm going to go to a 2-year chart so we can see that price action, that was a lot of steepening in the price of crude oil. In fact, we got all the way up to past $120 per barrel. Right now, you can see we're sitting at $69.59, so that's quite a difference in there. Really not the same fears as last time, but Vladimir Putin has really been thumbing his nose at OPEC Plus, and this could be a rift point. We don't know the inner dealings of OPEC Plus. They keep it pretty closed. But nevertheless, the Saudis announced earlier this month that they were unilaterally cutting 1 million barrels per production per day, and that's to stem the oil price downslide. And in doing so, they've pretty much acted on their own behalf, and they've taken money out of their own pocket. They would like the Russians to share in that, but so far they have not. So if there is that deepening rift, you got to wonder, to what degree does the price of oil play in all of this? So there's at least somewhat of a role. Also checking on natural gas, that's up about 2.5%. On the Wi-Fi Interactive, I'm looking at a 2-year chart, and this really doesn't compare at all to the price rise we've seen in previous years. Here's where we are currently at the bottom end of that range, between $2 and $3. That's a pretty low price historically for natural gas, so nothing too concerning just yet. Of course, we remember what happened with natural gas, especially priced in euros at the beginning of 2022. Moving on, let's just take a look at the sector action. Pretty broad-based rally, only healthcare and staples taking it on the chin, and those are defensive sectors, so in fact that is actually bullish that those two are in the red. Energy leading the way, that's up 1.5%, followed by materials, real estate, industrials, tech, financials, all of those outperforming, all of those contributing to the gains here. And I was just taking a look at some of my leaders and sentiment indicators, not too much red. We do see Bitcoin slightly in the red, that's down 1.5%, but at the very top we got regional banks, followed by solar energy, Chinese stocks, semiconductors, travel, our components, so all of those, that's a pretty broad mix. And we've been saying this rally has been too concentrated. We want to see a broadening out of it. Well, this is evidence in that direction. Nevertheless, a lot of bears weighing in, most notably Mike Wilson over at Morgan Stanley, saying he's still concerned about quantitative tightening and the fact that the Fed has to rein in over $1 trillion in liquidity. But for right now, smooth sailing on a Monday in the summer.
Yeah, gotta love that. Thanks so much, Jared. And there's one individual stock that we are focusing in on. That is Alphabet. It saw a rare downgrade this morning with UBS cutting the tech giant from buy to neutral, citing better risk reward in Amazon and Meta. Google's parent has been attempting to boost its AI integration efforts as it fends off competition from those other tech titans, as well as Microsoft and rival search engine Bing. There, Yahoo Finance's Ali Canal joined us with the details of this downgrade. So why do they like those others better?
Yeah, and there's a few factors fueling this downgrade here. I do want to mention that UBS did boost its price target on the stock to $132 a share, up from the prior $123. So UBS does see roughly 10% upside when it comes to that price action side, but not necessarily upside when it comes to current growth estimates on the revenue side. Now, I mentioned some of those risk factors. One, which you alluded to, is that better risk reward skew towards Amazon and Meta. Both of those stocks have current buy ratings at UBS. Other factors include new search competition, that TBD factor surrounding generative AI and how it could potentially hammer margins at Alphabet due to those heavy tech investments. In addition to the fact that generative AI is likely going to take time to both optimize and monetize. So UBS sees a bit of a bumpy road ahead, especially in the near to medium term. So overall, there seems to be this fear of the unknown here, especially in the face of all of this competition. If we take a look at the stock price right now, though, there's not too much of a sell-off, down roughly 1 percentage point year to date. The stock is up around 40%, so a bit of a rally there. But I do want to say it's rare to see downgrades at Alphabet. The last downgrade we got was May 15th from Loop Capital. That was the first downgrade since at least March 3rd, according to data from FactSet. And Loop Capital, they also called out sort of the risks surrounding artificial intelligence, citing, quote, structural uncertainties when it comes to AI. But guys, I think if we look across the tech sector right now, we're seeing a lot of downgrades for a lot of these Wall Street darlings. Alphabet, we saw another Tesla downgrade, Apple last week, and really high level, this comes down to, these stocks are really expensive again. So what does that mean?
Yeah, I think part of it is obviously price. One of the things I found interesting in this note is, and I've asked this question before to a CEO, is generative AI friend or foe? So, that question posed regarding Google. we'll continue to watch it and see if it is, I mean, for all of us, is generative AI friend or foe?
Yes.
Sometimes friends, frenemies.
Depends on how you look at it, right?
Exactly. Indeed. Ali Canal, thank you so much.
Thank you.
All right, as we head into the last week of the second quarter, several macro data points are coming in to round out the week, including the Fed's key inflation gauge, PCE, that's set to come out on Friday. And we have more data coming in. What can investors expect heading into Q3? Kenny Polcari of Case Capital Advisors, managing a partner, joins us now. Kenny, we appreciate you so much for joining us. First up, what are you watching? What's the biggest data point you're watching this week?
So I think, and I said it in my note this morning, I think you hit the nail on the head. I think the PCE is going to be the key one that doesn't come until Friday, because that is the Fed's favored inflation gauge. So they pay lots of attention to that. I think the other two data points that would be, of interest to me are going to be the home numbers, right? The pending home sales as well as the new home sales, because that's going to send another message about the strength of the housing market, the strength of the consumer, and are they in fact still rushing out to buy houses, and even as rates have ticked up. Now, look, remember, new home sales, you get like Toll Brothers and Lennar and all those guys that have their own internal financing. They can make it very attractive for new home buyers because they can work on the rate. They can buy down the rate. They can make it more attractive. So I think you have to be very, very careful about what these numbers might say, because I think the estimates call for them to be negative. I think you're going to see upside surprise.
And so what does all that mean for the market, Ken?
Well, so look, we're also in the final week of the quarter. So I think you have to take a lot of that with a grain of salt. I think you're going to see a lot of rebalancing and reallocation this week, specifically, right, as portfolio managers take some money out of the high-performing tech sector, which we all know we can name all the stocks. They're up double and triple digits, and then reallocate that to some of the other sectors that have been underperforming. But beyond that, now once the third quarter starts, we get into the summer. I do think that the Fed has managed to avoid a crash landing. Now, just what the landing is going to be. Is it going to be hard? Is it going to be a little bit less than hard? Is it going to be soft? I'm still not there yet, but I do think the Fed has done an admirable job of getting us through at least a crash landing. And then I expect that the market's going to do better as we move through the summer and into the fall. I would remain more defensive, though. I wouldn't go chasing tech up here at all, because I think tech is going to back off. But I would be putting money into industrials, basic materials, financials, even healthcare, which is a consumer staples, which are lower today because they are viewed as defensive. But I think if you're worried about the market kind of selling off into the summer and then rebounding in the fall, those are places where you're going to want to be.
Kenny, quick question. So we talked obviously about PCE. We have a jobs report coming out the end of the week as well. Does that even matter?
It does, because I think besides the PCE report, they're going to also then look at the jobs report. But the jobs report is not until it's the first Friday of the new month. So it's actually next week. It's not this Friday, because This Friday is the 30th. Am I right?
You're right.
Yeah. So
I'm ahead of myself.
Yeah. No,
I'm ready for the fourth already.
Yeah. But you bring up a good point, because that will be a data point that's that's also very keen to watch. So that'll be one of next week's key data points to watch. But yes, I think you have to be worried about what that non-farm payroll report is going to say. And is the Fed getting, relief on wages at all? Or is unemployment starting to tick up more than it has? Because we all know, based on what every economist tells us, that you have to see unemployment tick up in order for the Fed to be really successful. Some people say it's got to have a 5 handle on it. Meanwhile, it's got a 3 handle at the moment. Others say that it's got to approach even 6%. So it's going to be, if that's true, it could be a little bit of an ugly ride.
Kenny, I want to expand out the tech conversation a little bit, because you just heard Ali talking about that downgrade for Alphabet this morning. We've had some of the other tech flyers, especially Tesla, get downgraded recently. How do you think people should be positioning in these things?
So listen, I think that goes right to the point. Like I said, they have so outperformed. I think Tesla's up 110% this year, right? Alphabet's up 45%. Amazon's up 45%. These names are up big. And so what I suspect is going to happen, I think those are solid names to have in your portfolio. I would not be chasing them up here. I think they're going to come in. Like you said, you just got these couple of downgrades. I think they're trading at very, very rich valuations. They've been stretched. And so I think you should be patient. If you own it, That's great. If you want to own it, I think you need to be patient because I think you're going to get a better chance of buying them a little bit cheaper. But I would not be eliminating tech out of my portfolio at all. In my case, I'm not doing it. I'm just not adding new money that I'm adding to those sectors that we discussed. I'm not adding to my tech, but nor am I selling any of my tech because they're all solid names. They're names that I want. I collected the ones that pay divvies. I collect the divvies and just reinvest it. So that's how I'm positioned. But I don't think people should panic about tech.
Kenny, in your morning note towards the end of it, you say to sit tight as the week progresses. It does look like the market's doing that today. Is that basically how one should play the market this week through Friday?
Well, yeah, because I think it's, like I said, it's the last week of the quarter. So there's going to be lots of reallocation. Now, in that reallocation, there can be some short-term dislocations, which could provide an opportunity for an investor to put more money to work. But I wouldn't force anything. I'd wait and see how the market reacts. I do suspect that we are going to see some pressure as the week goes on. So I'm going to play it. I'm playing it just like I described it. I'm going to sit back and watch because I'm almost fully invested. So it's not like I'm missing out just in case the market takes off.
Kenny, finally, we got to talk cooking for just one hot second here, because for people who follow your notes, you put a recipe every day. Now, I am really happy right now because it's summertime. I went to the farmer's market yesterday. There is just a bounty. I think you're mostly based in Florida now, so I don't know if you're subject to some of the same seasonal variations. But what summer produce are you most excited about to cook with?
So listen, I'm actually going up to Cape Cod next week. I'll be up there for the month of July, so I will be subject to what's going on up in the Northeast. But I'm excited about all the vegetables, right? About the zucchini, about fresh peas, about vine-ripe tomatoes, making a delicious, like I call it, a pasta fresca sauce, right? It's just making a big tomato salad with chunks of mozzarella in there, and then putting that over hot pasta with plenty of grated cheese. It is simple to make, and it is so delicious if you get tomatoes right off your garden, right from the vine. They're absolutely delicious. But I'm excited about, certainly going up to the Cape. So I'm excited about the fish. I'm excited about the lobster. But in terms of the vegetables, I'm excited about, anything that grows because I love to cook.
You know what? I also like a little tomato peach salad, like bringing together two different things, a little basil.
Tomato watermelon salad is great with feta cheese. I love that. That's a great summertime salad.
I'm ready.
I'm going to try tomatoes and peaches, though. I've never tried that.
You should try it. I recommend it.
You put feta cheese in it?
Yes, it's good. It's good in there. Yeah, a little salt.
I'm going to try it.
All right, we can just do another hour on this. Kenny, it's great to see you. Such a pleasure for Diane and I. Kenny Polcari, Case Capital Advisors Managing Partner. Thanks.
Thanks. Bye-bye.
Coming up, investors largely brushing off a failed coup in Russia, but are there political risks beyond the Kremlin that we need to keep an eye on? We'll dive into the unknown unknowns for investors next.
It is just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Diane King Hall alongside Julie Hyman. We're 30 minutes into trade, so let's get right to where markets are at the moment. They are trading in a narrow range, and let's check Carnival. Those shares under pressure this morning, down about 5%, so off of their lows. Despite reporting second quarter results that came in above expectations, as the cruise operator saw a jump in demand, reaching an all-time high for quarterly bookings.
We're also watching shares of Tesla after Goldman Sachs became just the latest to hit the EV maker with the downgrade, cutting it to neutral from buy, citing a difficult pricing environment that could weigh on the stock. Goldman joins Morgan Stanley and Barclays, who also downgraded Tesla last week.
Meantime, shares of Wolfspeed on the rise today after Apollo Global led a $2 billion deal to help the semiconductor company expand in the U.S. Now, according to Bloomberg, Wolfspeed will be able to use $1.25 billion immediately, shares getting a bump up 6%.
From consumer confidence to some key earnings reports, there's a lot for investors to unpack this week. Yahoo Finance's Josh Schaefer is joining us now with the breakdown and some highlights here. Hey, Josh.
Hey, Julie. So we got a fun calendar this week.
I like your calendar.
Leading into the holiday. I'm excited for this calendar, right? We're taking a look at what we got on Tuesday. You're looking at new home sales there and consumer confidence from the Conference Board. I'm interested in that new home sales number because that's something we're starting to see increasingly come up from economists when talking about persistent inflation and consumers' willingness to continue to buy high-priced things. Housing is one of those things. So curious to see what we see from both new home sales and those mortgage applications and even pending home sales on Thursday. It's going to be an interesting week in housing as, again, we're seeing that as an increasing thing. I'm seeing that as an increasing thing economists are attributing to persistent inflation. And then when we're talking about inflation, on Friday we have the latest PCE index report. That is, of course, the inflation print that Federal Reserve Chair Jerome Powell has been consistently referencing as stubbornly high. So we'll get another reading of that this Friday. Will be interesting to see where that number comes out. Right now, economists project that month over month core PCE number, which strips out energy and food, to be about equal to what we saw last month. So not coming down, which overall, not a good read. Now, if we take a look at some corporate stuff too, we do have a couple earnings this week, guys. We had Carnival out earlier today, and then we have interesting ones when you think about sort of the COVID rebound, what's happening to these companies that sold a lot of vaccines and had a lot of vaccine distributions. That's Walgreens, that's Rite Aid. Also just general consumer notes here when you think about General Mills and McCormick. What are people spending on, and are they buying shoes? I'm excited for Nike on Thursday. You guys know I love Nike,
Yeah.
but also excited when you think about the overall retail environment and we think about Nike, right, and sort of what they mean for retail. Does Nike still have inventory coming down? There's a lot of concerns that inventory might not be coming down at the faster pace that it was. There's also concerns of what we're seeing in the wholesale market. Nike also sells a lot to Foot Locker, right, who told us things weren't going so well. They sell a lot to Dick's Sporting Goods. How does that play out, and what do they say about the overall retail economy? Nike's considered a bellwether there. So we're excited for Thursday.
I like the
Yeah,
charts
me
you
too.
brought us today, Josh. Great stuff on the economic and earnings calendar. Josh Schaefer, we appreciate you. Meanwhile, Bitcoin hovering around that $30,000 mark after getting a boost from the potential launch of BlackRock's Bitcoin ETF. But our next guest warns that this won't shield the asset from its first U.S. recession. Mike McClellan, Bloomberg Intelligence Senior Macro Strategist, joins us now. Mike, good morning, first off. So tell us about so crypto had been going through what we call a crypto winter, which includes Bitcoin, obviously. But it's seen a bid recently. Why do you say that it is, this seems like it's temporary, I guess.
Well, Bitcoin bulls hope it's not temporary. The key reason it had this bid recently because the BlackRock application for an ETF. Most people think that means they will be approved in the U.S., but that's still an if statement. It might not happen this year. And the key thing to remember about Bitcoin is when this whole situation started with COVID, it went down with the Nasdaq, went up with all the liquidity. It's gone back down. Now it's gone back up with the stock market. So for it to show divergent strength away from the stock market, I think it has to probably get through this recession, which we all know is coming. If you certainly look at the yield curve, it's a matter of time. And to see if it can show divergent strength with the stock market going down. As the Fed has pointed out, they are not going to be there to cut rates, which probably is bearish for equity markets. Or does Bitcoin outperform on the way up? I look at it as it's got to prove itself. And at 30,000, about 3,100 this weekend, at 31,000 this weekend, I think it's just a little bit too risky here, particularly if we tilt over to that recession that brings most assets, risk assets, lower.
Hey, Mike, it's Julie. It is fantastic to see you. So it sounds like you don't think it's going to hold above 30, certainly in the near or even medium term.
Well, I'm much more worried that of the whole tide going out because of this recession and the risk that everybody's priced in for the bullish scenario. The Fed's going to ease, the Fed's going to save us. Yet Jerome Powell said he's not going to. You look at the interest rate expectations, there's not going to, there's still price for higher rates. And we're getting liquidity pools, meaning higher rates in England and Canada and most of the rest of the world. That's just not a good environment for an expanding global economy that's maybe tilting over to recession. People are hoping for, even if we go for recession, the Fed will ease and save these risk assets. The key point is Bitcoin is still very much trading like a risk asset, like the stock market. Now you look at things like gold and treasury bonds, they might be better off. So it's got to prove it. And the best way to prove it is to get through this recession and prove it. Otherwise, it's just a faster version of the stock market, which I think most people are looking for, this faster horse in the race to transition to trade more like maybe gold and long bonds. And basically, you have to be bullish the stock market here and expect Bitcoin to outperform. Otherwise, to me, the key risk is the tide goes out and Bitcoin's the fastest horse in the race, and it kind of leads the way.
Mike, so we also know there's been a crypto crackdown, if you will, when you think about Coinbase, Binance. What do you make of the regulatory climate for crypto? It seems to be simmering recently, but that it could just be a back burner thing right now.
It's going to last for a while, but this is a revolutionary technology. And oftentimes that's what humans do when something comes in that they don't understand, which is okay. The key thing about the crackdown, I think, is prudent, is we have to purge some of the massive speculation in this space. All revolutionary technologies have massive speculation. I was reading this weekend about RCA, the radio company, went from 3 to 300 and then back down. These things happen. But there's 25,000 cryptos that needs purging. And then there's Bitcoin and Ethereum and crypto dollars. That's very significant revolution technology. The key thing is Bitcoin's going so far, so fast, and it still just has it's got to prove it's not just going to go up more than the stock market. And that's the key thing that most of our viewers and listeners have not lived through, a true stock bear market where it drops 20%, the Fed doesn't save you, and then it drops another 20%. To me, that's the risk in the broad market.
Mike, I want to turn to more traditional commodities now, especially in the back of the news out of Russia over the weekend, where the coup seems to have been averted. We are seeing a little bit of a lift to oil prices, but not that much. But maybe this is a reminder for us, right, that the situation's still happening. The markets have sort of adjusted to this as the status quo, but that can change, right?
Well, it is great to see you, Julie. I glanced down to see you on the screen a little bit. I haven't seen you in a while since working with you at Bloomberg. But crude oil commodities are a bear market. They're down. They were down almost 30% for a little while from the peak, down 20% now on a year-over-year basis. And the key question you have to ask yourself is what's going to stop this and save it? Typically, it takes a long and variable lag. The Federal Reserve easing. What are they doing? They're still tightening. Now, you see what's happening in China. China's leader made a major mistake of his unlimited friendship with Mr. Putin. And what's that doing? Overall, to me, it's tilting the whole world towards recession. China's having a problem with all the data is disappointing. That's the body in motion. You have to ask yourself what stops it. So I see crude oil is more likely to head towards 50, maybe even 40, priced on what's already happened. Natural gas has already done that. Natural gas went from 10 to 2, and now it's bouncing. And I see the whole commodity market in a bear market, and the question is, I don't see anything stopping it. So I think the best commodity might be continue to perform well in the next year or so, is probably gold as we tilt towards recession. And maybe we eventually get a Federal Reserve pivot or ease. But for a commodity bottom in the commodity market, typically we are way too early. Typically, you need to see a lag to easing, and we haven't even started that yet.
But Mike, okay, so you're seeing crude head down to 50 right now. We just put up a chart where crude is sitting near $70 a barrel.
Yep.
You know, I mean, that seems like such a sharp drop from where we are now. And you know, the talk of a recession is starting to kind of be pushed back from a lot of analysts and economists that we speak to. What's the base case for crude heading to $50 a barrel?
So I like to ask what part of an inverted curve, plunging commodities, and the Federal Reserve and most central banks still tightening leads to the recession being over. Right now, we're seeing a bounce. But I did make the call for $50 a barrel a long time ago when it was much higher and it was on the way up. That is the trajectory. The key thing is that's what it always does is commodities always go towards near their cost of production in the long term, in particular when economics get a little dicey. And that's happening right now. $50 is the average cost of production in the U.S. In natural gas, the average cost of production is around $2. That's where the market's bottom. So right now, the key question I like to ask you and our viewers and everybody else is what stops this bear market in crude oil? OPEC's trying to help by cutting supply, but typically what happens when OPEC cuts supply, that happens in bear markets. They're responding to what they see in the macro in a prudent way for a cartel that's trying to boost prices.
Mike, presumably, if indeed there were some sort of resolution to the conflict in Ukraine, some sort of change in leadership in Russia, you could envision a scenario where you would actually have a pretty big increase in oil supply, right? It probably wouldn't happen right away, but would that be the outcome?
Well, that I think that's a good point. First, I would expect grain prices to go lower. They already have because the supply elasticity picked up. Remember, Brazil had a bumper crop last year because of prices. Crude oil would probably collapse. I think it would be very good for the global economic situation that pressure from this war would be alleviated. To have a change in power depends on who comes in and how they do it. But overall, that would be a relief and it would accelerate the commodity bear market, I think. And that's the key thing to remember is we're in a bear market. What stops it? Typically, you need some major catalyst, and usually it's from a demand side. And usually from a demand side, you need global economic demand pull, and typically you need some help from some Fed and central banks.
Mike, great to see you. Mike McGlone, Bloomberg Intelligence Senior Macro Strategist. Be well. Thanks.
Thank you.
Coming up, risks ahead. We take a closer look at the implications of the failed coup in Russia and also some domestic issues, including stress tests for the banking sector. Over the weekend, private military organization Wagner revolted against Vladimir Putin's government, creating one of the biggest challenges to his regime in decades. The coup failed, but can the Russian president keep a grip on power? Let's bring in Allison Vaderka, who is Geopolitical Futures Director of Analysis, to discuss. Allison, thanks for being here. So this is, at least to the outside world, one of the most direct challenges to Putin's hold on Russia. What sort of happens from here? Is this the last we hear of Wagner? Are there other elements within Russia that could provide future challenges?
So I'll start with that second part. There are other elements that are in Russia that could provide future challenges. These groups have been present since the beginning of the war, and one of the biggest questions in terms of how will this war end came back to what is the situation in Russia going to be like? You had some tension within the top brass in the Ministry of Defense in Kremlin, especially after in the first 2 months back in 2022, the offensive didn't go quite as planned. You had these groups like the Wagner Group coming in to help out. There was tension there in terms of logistics and supplies. And then you also had oligarchs who saw post-sanction a big drop in the amount of money that they had that also made them question Putin or the impact of aligning with Putin would have on their bottom line. So there's several different interest groups in Russia that are paying a price for this war that Putin needs to find a way to manage. Prior to the weekend events, the Kremlin and Wagner Group worked collaboratively. The Wagner Group has been very helpful for the Kremlin in their operations in Africa. And even in fighting in Ukraine, they were the fighting force responsible for a lot of the Russian success that they saw on the battlefield with Ukraine, because a lot of these fighters are very well trained, and they also are very well paid compared to the Russian military. So they have a lot of incentive to keep on fighting. As for where we go from here, the fact that the coup did not work means that Putin is still in power. And it may sound simplistic, but at the end of the day, that means there's enough people in his inner circle, in the government, in the military, that are loyal enough to him that he can remain there. Now, of course, there's always going to be power plays, but as long as he's still in power, then we know kind of where things stand and what he needs to be doing. If we see major reshuffling of military people, if we see social unrest breaking out, if we see any reports of unrest in the military, people being critical, that's when we have a sense of, okay, Putin maybe doesn't have as much control and did not survive this coup as strongly as he might think he did. But he has done a very good job of talking to other foreign leaders, trying to reassure them and things like that. The two other things in terms of the fighting in Ukraine to be mindful of is, one, it's not entirely clear if Wagner will come back and fight with Russia, meaning one of their best fighting forces may not return to the battlefield, which could shift the dynamics there. And then two, this prospect of a negotiated settlement. Once you have something like this happen, people are questioning the staying power of Putin, which makes a negotiated settlement extremely difficult because they want to know that the person they're negotiating with is going to be around and can actually enforce any agreement that people come up with. So until people can be certain that Putin is the man in charge and is the person that they can talk to, the idea of a negotiated settlement with Russia is now just off the table.
Allison, I want to ask you, you said they're very well paid. Who is financing, or where's the financing for the Wagner Group coming from?
So that is a little bit of an opaque answer there. They do some financing of their own in terms of, for example, think of them as a private security firm. And so when they go into places like Africa, you have governments, you have major companies that are going to pay for their security so they can get money that way. There's also patrons among the oligarchs and things like that within Russia that will also give them money as well. But as a private mercenary group, they have a lot of access to black market money as well as financing from their own operations because of the fees that they will put on other people to guarantee things like security.
Allison, why didn't this coup work?
So typically, there's a few things you want to do when you have a coup. One is make sure you have most of the military behind you. And 2 is gain a hold of all of the communications so that you can be in control of what people are hearing and seeing. And 3, I would even say, make sure that where you carry out your operation, it has a high level of impact. And we did not see any of those 3 traits from what the Wagner Group did. The city that they took over in the south, Rostov-on-Don, it's important for grain export, but the power centers of Russia are not there. They are in Moscow. There are some in St. Petersburg. They didn't really go after any of, taking out of the leadership or anything like that. They didn't have a strong response from the military to back them up. In fact, a lot of the military came out and said, please come back to us, started doing security operations around Moscow, starting to do operations to prevent the group from advancing north. And then, of course, they never really bothered to try and get in control of communication, news channels, internet censorship, what have you, so that they can control the narrative and they can structure any type of power takeover before word gets out that that's actually happening.
So, Allison, I'm sorry to interrupt, but so was it really actually a coup attempt, or was there, right? Or was there another goal here that they had in mind in doing this action?
So there's a couple of different theories, I think, that you can make the case that it wasn't necessarily a true coup attempt. One would be that it is a classic example of a Russian deception campaign in terms of trying to create an image of perhaps a weaker Russia, create distraction so that they could move military forces for some type of action in Ukraine. They also needed to find ways to perhaps make Putin look like he's in control. If you say it was a failed coup, he's obviously in control. He looks strong. The angle they had by involving Belarus makes the Belarusian president look strong. He was having problems domestically. So being able to position himself as a negotiator would have helped improve his image, which is important for Russia's overall international relationships. And as for the Wagner Group, he can still find ways to be useful in the war. And so even if, for example, Prigozhin does not, he hasn't really been very public recently over the past 48 hours, he can still find ways to benefit if, push comes to shove, the fighting continues. His force is too useful and too good not to be included in Ukraine, and he can enjoy that as well.
Allison, could this cause kind of any deepening of a split in terms of ideologies in Russia? For instance, some were not on board with the conflict with Ukraine. How do you see it?
I think the ideology is probably harder to see a split in, and that the question is going to come down more to the impact on daily life that it has. So there were some people that were not on board necessarily with the invasion in Ukraine, but there has been a lot of work going on in Russia in terms of nationalism and using media to get people on board with the war that's going on and the operations that are going on. In addition, there is a lot of education that goes on in Russia that explains Ukraine is part of Russia. Mm-hmm. So there are other people in Russia that genuinely believe Ukraine is territory that is rightfully belonging to Russia. I think we're going to see a lot of problem in terms of potential political backlash and domestic unrest will be if the economic consequences of this war become so great that people can no longer meet their basic needs, and then they blame the government, who is clearly going to be the party responsible for that.
All right, Allison Fedorka, thank you so much. Geopolitical Futures Director of Analysis. We appreciate you. Thank you. All right, switching gears, shares of California-based regional bank PacWest are up nearly 5% today following an announcement the lender made this morning that is selling more of its loan portfolio. Yahoo Finance senior reporter Dave Hollerith has more on the mid-sized bank's latest moves. Dave?
Yeah, so PacWest is selling about $3.5 billion of its loan book to alternative investment manager Ares Management. And this is just the latest of several moves PacWest has made to sort of shrink its balance sheet and increase its liquidity requirements. And this is significant given that it is sort of a trend. PacWest has obviously been one of the banks that has sort of faced more scrutiny from investors since the collapse of Silicon Valley Bank. But it's part of a trend that we're seeing sort of for most banks across the sector. They're getting into more of a capital building phase right now. So it is worth pointing out that since the beginning of May, which is sort of where we've seen regional banks kind of bottom out, PacWest, along with just generally regional banks, have rallied for 4 of the past 6 weeks. Last week they closed down slightly.
And Dave, we're halfway through the calendar year. Analysts starting to publish their second quarter previews for banks already. It's hard to believe we're going into the next earnings season soon. Up till now, the banking sector has settled with the majority of regional lenders seeing a rally in recent weeks. What can we expect for the upcoming quarter?
Yeah, I mean, settled, relative calm. I mean, things are definitely better than they were in March and April. We don't know what the future holds, but one thing we have seen just in the last couple of weeks is that there have been a number of banking conferences where executives have come out and they have offered downward revisions for their profits for the second quarter. And this is like not surprising at all, given that, under the constraints of higher deposit costs, which obviously was exacerbated by SVB, but it was a problem before that just with higher interest rates, that we would see these banks would see their profits be squeezed. But that being said, Wedbush coming out today, their banking team saying that, they expect to see more downward revisions in the weeks ahead, especially in earnings, I mean. So, this is a part of just a broader move of banks continuing to be squeezed. There's also concerns of regulatory pushes for higher capital increases, which back to the PacWest situation, obviously different, but banks of all sizes are sort of in the capital building phase right now, and they're not really sure exactly how much they will need to sort of increase capital buffers at this point.
Yeah, it'll be interesting to hear their commentary around all of that when they start reporting as well. Dave, thanks so much. Coming up, another day, another downgrade. Is the Tesla rally really set to come off the road? We're going to break it down next. Goldman Sachs today joins a slew of other banks downgrading Tesla, the firm cutting shares of the electric car maker to neutral from buy, though also increasing the company's price target to $248 from $185. Joining us now, Yahoo Finance's Prasad Subramanian to discuss more with us. I mean, it's just like a pile-on at this point.
Yeah, what it is, one's an occurrence, two is a coincidence, three is a trend, right? So we have a trend going on here. Again, pretty much the same kind of call with the other banks there. It's a valuation thing. They're talking about how it better reflects, the stock now better reflects what they think is the long-term view of the company, and downgrading to neutral as not as an overweight kind of position for investors. Talking about things like, they didn't see the round coming, right? They didn't see it coming, but they're surprised by it. But they think it's due to things like reports of better sales in April and May, not official reports, but just reports. Less discounting than they thought. The milder you're getting the full tax credit, the charging deals, and then of course the AI sort of frenzy. So all that sort of led to the stock, a huge move for Tesla this year, in particular last May. So kind of a big deal there. So they mentioned that, but also they said the company's still well positioned. And like you said, they hiked the price target. They're really sort of behind there in terms of where the stock is right now. But they also actually hiked their estimates for next quarter too. So there is that for that sort of position move up higher.
It does. I agree with Julie. I thought that it does feel like a pile-on. It's like if you can't beat the rest of the analysts, join them.
Right. And it's funny because the downgrades are coming even as most of them are raising their price targets.
Right.
Yeah.
So they still expect the stock to
perform
be
better.
higher than they
Exactly.
Yeah.
Potentially, yeah, and for Goldman, they're still below where the price of the stock is right now, but they brought it up considerably, so they're confident of at least maintaining that level for now. But like you said, it's just following the train, right?
Yes.
The stock starts shooting up. We got to catch up. We got to catch up. So
exactly.
I know you follow this pretty closely.
Yes.
So yeah.
And I want to just talk about one other kind of EV play that we've been watching today, the Lucid Aston Martin deal. What do you make of this?
I'm surprised to see that Aston Martin's doing this, and it's a good thing. But a lot of people have been waiting for Lucid to actually start licensing their technology. That was a big play for them because they make their own batteries, they make their own inverters, they make their own motors, obviously software too. So it's a sort of a big play that they have from an IP point of view. So good to see Lucid doing that with Aston Martin. They're going to take a stake in the company as well, in addition to some cash considerations there. So it is a nice deal to see for Lucid shareholders. I mean, the stock has been down a lot recently, so this is a huge pop today for them. And
Aston Martin got a big bump up as well in UK trading. Does Aston Martin make EVs already? Is it just a question of, like, how is the Lucid technology and their parts viewed in the industry? And will we see more other automakers maybe wanting to get their hands on it?
So I tested the Lucid Air. It's remarkable, really powerful powertrain, but also very smooth, really well done, really dialed in. There is Motor Trend Car of the Year 2 years ago. So it is well received. So it is a best-in-class EV solution, I would say, for automakers. And this Aston Martin is supposed to have a car in 2025. They have no EVs out right now. And they were partnering with Mercedes to do these sort of things. Right. So Mercedes might take a step back, do more of their gas-powered car powertrains. But Lucid, I think, is their partner going forward for EVs and beginning 2025.
Interesting. All right. We're going to have to put a bookmark. I can't find the right pun for this one. Right.
Electric pin? I don't know.
Yes, exactly. All right, Prasad Subramanian, thank you so much. All right, coming up, the data-dependent Fed has lots to chew on ahead of the next rate decision. But where should we be focused in the coming weeks? That conversation is up next. U.S. Treasury yields in focus this morning as investors prepare for a week of fresh economic data that will better illustrate the state of the U.S. economy. On the docket, consumer confidence, new and pending home sales, and PCE and consumer sentiment. Joining us now with what to expect from the week ahead is Bill Adams, Comerica Bank Chief Economist. Bill, thank you so much for joining us. So first up, what would you say is the main target this week? Would it be PCE in your view?
I think that's probably what's going to be most important. That'll be both the state of the consumer with spending on services as well as goods. We haven't really seen as much service data for the month of May yet. And then on top of that, we're going to get the Fed's preferred measure of inflation.
And so is that going to come down, do you think? Are we going to be going in the right direction, not just for that data, but any other upcoming inflation data in the coming weeks?
We're in a part of the year where the inflation data is really getting graded on a curve, and it's an easy curve because the year-over-year comparison is now comparing against the spring and summer of 2022 when energy prices were surging after Russia invaded Ukraine. So something would have to go really, really wrong for inflation not to slow in the month of May in this release. I think the bigger question is going to be what happens to sticky service prices. And the Fed has said that they are concerned that those sticky service prices, that's the cost of getting a haircut, the cost of sending your kids to daycare or getting your car repaired, those are not slowing as much as energy prices or food prices. And the Fed wants to see the overall economy cooler so that we see less pricing pressure, less pricing power from businesses and less pricing pressure from wages, bringing overall inflation lower, not just this year, but next year as well.
Bill, the housing market has held up strong recently, and we have more housing data coming in this week, new home sales, et cetera. Are you expecting the housing market to remain resilient?
I think the housing market's going to be resilient in the second half of this year. And I think there's a good chance that the bottom, both for residential construction, as well as the bottom for new home sales is in. There is a big drag on home buying power from high mortgage rates at this point. But high mortgage rates also mean that a lot of people who might have downsized, might have moved, might have sold in 2023 are holding on to their 2.75% mortgage and are not putting that home on the market. And that means there's just much less supply of existing homes. And that is funneling home buyers into the newly built segment and really supporting construction and transactions in that part of the housing market.
Does that also imply, Bill, that once rates stop going up or even start to go down, that we will see more of a lift to the housing market than we would have traditionally?
Another way of thinking about it is that the Fed is going to be more reluctant to cut interest rates given how resilient housing has been. And so while I think that the Fed's next decision, probably a 0.25 percentage point hike in July, I'd say better than 50-50 that that's the last hike of this cycle. But I'm now thinking that the Fed will probably go quite slowly in 2024 in reducing interest rates. Right now, I have rate cuts penciled in only quarterly next year, so still leaving short-term rates at a relatively high level at the end of 2024. And that's different from what I was thinking 3 months ago when I thought housing was going to be more of a headwind to the economy and that headwind would last longer.
So, Bill, what other differences have changed in your view on the economic picture? From your view, are we headed to a recession still this year?
You know, I have that recession in my forecast. It's for economic forecasters, we're kind of in the extraordinary claims require extraordinary evidence at this point. And with the yield curve so inverted, you kind of have to have the extraordinary evidence that the economy wouldn't have a recession. The Fed's own, the New York Fed's forecasting model based on the yield curve has a 70% odds of a recession over the next 12 months. So to say that, you know, the other 30% is going to come through, you need to point to something really remarkable going on in the economy now, keeping it out of recession. There are some good things happening, though. In addition to housing, you've got consumer incomes, household incomes outpacing inflation since June of last year. And the labor market in general is remarkably resilient. Labor force participation of workers under the age of 55 is at the highest in over a decade. So that side of the economy is holding up quite well. It's possible we'll dodge a recession. I think right now the central case is probably a mild pullback in activity, and we can argue over it for months and months once the data come in, whether it was just a soft patch or an actual mild recession. But I think the odds of a more serious recession seem lower than they did 6 months ago.
Bill, this week, the Supreme Court is expected to rule on the Biden case involving the student loan repayment moratorium and kind of determine what happens next. If the moratorium expires as expected in September and there's no other legislation on that front, what effect is that going to have on the economy and consumer spending?
Well, people who are spending more to pay back their student loans are going to be spending less on everything else. That's obvious. But I think the question is, how does that play in the mix of other things affecting consumer spending in late 2023 and 2024? And there is a lot of support to consumer spending right now from the very solid labor market, from solid wage gains, from less inflation, gas prices down from their peaks last year, and a lot of consumers who have fixed rate mortgages who are not exposed to the increase in housing costs are experiencing less inflation than you see in the CPI index. So that's the support. To the downside, you have the restart of student loans, and then also these long and variable lags of monetary policy that are likely to make credit-funded parts of consumer spending, think auto sales, grow less quickly in 2024 than they otherwise might have.
All right, we'll keep an eye out for that ruling and see what happens with all these other variables for consumer spending. Bill Adams, Comerica Bank Chief Economist, thanks.
Thanks for having me.
In this day and age, media literacy is becoming increasingly important in everyone's life. I spoke with Bear Grylls, a well-known adventurer, TV host, and author turned mission seeker developer, that's his new website, on his partnership to increase media literacy.
Mission Seeker is all about empowering young people with digital literacy skills. And as you know, I think for young people, this is a really pressing issue. We all want our kids, as parents, we want young people to be empowered to know what is real online, what is misinformation, what is clickbait, what's going to drag them down some weird rabbit holes, and trying to put good stuff out there. So Seeker doing that as a search engine, family-friendly search engine. Mission Seeker is about providing inspiring adventure content and getting young people to come and be part of that adventure, but get trained, get the modern survival skills, which, as you and me know, modern survival skills, being literate digitally is a modern survival skill. So that's what that's about. We've got some great young ambassadors who are going to be leading the way, setting these missions, whether they're environmental or humanitarian. And then we're just going to have tens of thousands of kids out there sending in their mini adventures for us to build that community around. But inspiring, safe space for young people to get smart online.
Yeah, and there are already some missions and some adventures that are up on the site, even as it goes live here. This is something that strikes close to home for me. I have an 11 and a 14-year-old, and they are around the dinner table will consistently bring up something and say, well, this is true. And I say, well, where did you find out that information, right? What is the source of that information? Because they do have this sort of fire hose of content. So specifically, how does Mission Seeker help them to distinguish what is real from what is not?
Well, Seeker is smart because it's AI generated to try and put those filters in place. So the information your kids are getting, can be reliable. It can not have misleading headlines that have nothing to do with the article, that the facts in the article have proper sources. That the article or the video or the link you're clicking on isn't just going to be, as I say, that clickbait that's going to drag them somewhere else. And I think sort of this gulf for young people now between getting information and the speed that information is coming at them, it's an exponential wave, isn't it? It's like a tsunami of information. And it's almost hard for us as parents to keep up with. Kids are always ahead of the game. But if you can provide them with the framework, that search engine that is doing some of that filtering for you through AI. For me, it's an example of AI for good. You know, we hear a lot of bad stuff about AI, how scary it is, but actually AI can be a real tool for good. And I think Seeker is an example for that.
Speaking of exciting content, you are about to launch season 2 of Running Wild with Bear Grylls, which is you with various celebrities, actors, entertainers out doing what you do. It's going to be on National Geographic. And that brings me to the idea of streaming, right? Because you have moved around a bit in terms of streaming platforms over the course of your career. How do you decide when you're making those kinds of deals, which streaming service you're going to partner with?
Yeah, you're right. I mean, we've done shows for Nat Geo, for Discovery, for Amazon, for Netflix, for NBC, for many different networks. And I think all of these are portals and windows into what inspires you. You know, my job is to make the content, bring those adventures to life, make those adventures inspiring and accessible for people. And the platform is exactly that. It's a platform. It's a shop window into those. But I think in this modern world, there are no rules. You know, it used to be like, oh, if you make shows for those, you can't do it for those. But it's like, there are no rules. I think you create your own destiny, don't you, with so much of this. And, you know, in so many ways, the media has been like a Wild West for a while. And there's a positive part of that in the sense that it rewards pioneering spirit. It rewards people who are actually out there on the front line making stuff. And I think ultimately, if what you make is good enough, the platforms will always come to you and want it and allow you to dictate a little bit of the terms. But I'm really grateful to our partners. We always try and look after them on that trust that they give us to make good shows back. And I think actually the future of streaming platforms is really exciting. You know, it's wide open and we can refine the stuff we're interested in more and more. But I'm not someone who kind of runs away from the progress. I think we've got to be on that front line. We've got to be creating that progress and just adapt, always being adapting, because I think the media world, the technology world changes so fast. If you're slow to adapt, you get run over.
That was our Julie Hyman's interview with the great adventurer Bear Grylls there, talking about the next frontier. Coming up, all you need to know for the day ahead. We've got stocks trading in a range this morning. Stay with us. Well, we've got some great interviews on tap all day here on Yahoo Finance. How Americans can reach their savings goals in 2023. Our Rochelle Akufo will speak with a financial advisor from Vanguard. That's in the next hour.
Plus, why one strategist is saying the new bull market may need a breather. It's got a little bit of one last week. Rochelle's going to get a pulse check for investors straight ahead.
Carnival shares are under pressure this morning on the back of its latest quarterly report card. Stay tuned for our 3 to 5 p.m. show where Shauna Smith and Akiko Fujita will speak with the company's CEO, Josh Weinstein. You don't want to miss that.
And let's take a look at markets before we leave you, because as you've been saying all show long, we've been trading in a really tight range here today. Indeed. And that is continuing. But now the bias is very slightly to the upside, whereas when we got out the gate this morning, it was very slightly to the downside. Exactly. So we got the Nasdaq up by about 1/5 of 1%. We've got a bounce back in some of those large cap tech names. The S&P really little changed, as is the Dow. I mean, you can call it mixed to little changed really all across it today. But Jared Blickery is also going to be along in a few minutes to give people a little more visibility into what's going on. Exactly.
Jared.
That's right. Have a great Monday, everybody.
All right.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Acutho. Here's a look at what I'm watching this morning. Investors largely brushing off a failed coup in Russia to kick off the last trading week of June, with several key economic data points on tap. We'll speak with one strategist who says the bull markets may be in need of a breather. And Carnival not cruising along this morning, despite record high quarterly bookings in the second quarter. But higher price tags for marketing and labor have investors shrugging off that better than expected report. And the eternal push-pull. We're watching oil prices after OPEC said it expects global demand to rise to 110 million barrels per day by 2045. And this would mean a 20% jump in the world's energy demand. Is this a likely story? That conversation just ahead. But first, let's check in on the major indices an hour and a half into the trading day. Looking at a mixed picture here, that we're seeing major indices traveling really being in a narrow range so far this morning. The Dow ever so slightly in negative territory, just down about 30 points there. The S&P 500 there, just barely in the green there, but up about 2 points. Tech-heavy Nasdaq there, at least the strongest gainer so far this morning, up about 20 points, or about 0.15%. Let's also check in on the Treasury market, as we do have a week of a lot of economic data coming in. We're seeing something of a flight to safety here. The 5-year down about 0.5%, the 10-year also down about 1/3%, and the longer-term 30-year yields down about 0.2%. Well, investors are shrugging off the failed coup in Russia. The leader of an armed revolt against Vladimir Putin's government ordered his forces to turn back. The move is being labeled as the biggest challenge to his regime and the Russian elite in decades. But US stocks seem unaffected by this news, even moving higher as we settle into the trading day. Joining us now with more on this is Yahoo Finance's Jared Blickery. Jared, an interesting result here we're seeing so far.
Yes, just another ho-hum Monday on Wall Street. Wasn't like this when the Russia-Ukraine conflict first reared its head in the first quarter of last year. But check this out. Dow is only down 12 basis points. That's about 0.1%. Meanwhile, the Nasdaq is up a similar amount. S&P 500 just barely trading water. And let's check out the volatility in the market. This is the VIX. This tracks equity market or stock market volatility. This is up slightly. You can see off of the lows here, but with a 14 handle, those are levels that we really haven't seen until recently, a few years back. So really, we are still looking at pretty low levels of volatility in the market. Also want to check out the VIX of the VIX, which can lead sometimes a little bit more elevated than the VIX itself. But then here's the bond market volatility. To be fair, this is as of Friday's close, so not reflecting anything that happened over the weekend. But you take a look at what's happening inside the bond market. Here's the 10-year T-note yield. It's only down 1 basis point. Really not seeing too much of a reaction. Now, when we take a look at stocks, we do see energy. That is up the most, 1%. That could be because people expect the price of oil to be higher. However, you take a look at what's happening with the price of oil. It's just about barely treading water. Let me see if I can find CL equals F, up 14 basis points. And here's the 2-day price action going back to the open last night. I can tell you, and I can actually show you, back in the first quarter of last year, we got this huge surge in crude oil prices, and nothing like that this time. So really muted price action. We can also see that in the natural gas market, which is up slightly, about 1% today, but still, this is a 2-year chart. You can still hanging out in the lower end of that chart. So really not a whole lot of consternation just yet. And then just to round out some of our analysis today, let's take a look at what's leading here. KRE, that's regional banks. That's a fairly good sign. TAN, solar energy, chip stocks, IPOs, transports, Korean stocks, Chinese stocks, ARC stocks. You take a look at all of those. That's a pretty healthy, broad-based mix here. So I would say not a lot of consternation on Wall Street over what's happening with respect to Russia. Just another one of those days in the summer, Rochelle.
Indeed, and as you mentioned, they're a very different reaction than from when Russia first invaded Ukraine. Markets have other things to worry about, I guess. A big thank you there to our very own Jared Blickery. Well, investors are betting that the bull market is just getting started. CBOE Global Markets data shows investors piling into options contracts for the Nasdaq Composite and the S&P 500 index. Fear of missing out on the AI hype also means that the bulk of trades are piling into chips and other big tech stocks, leaving a wide breadth between the market winners and losers. Well, could that gap close in the coming weeks? If so, which sectors should you be betting on? Joining us now is Adam Turnquist, LPL Financial Chief Technical Strategist. Good to see you, Adam. So break this down for us, because we could be, as you said, perhaps getting a breather, or perhaps this bull run might be due for a breather. What would that look like?
Yeah, I think it's just a case of a little bit too much too fast for this bull market. We've had a great run off the October 2022 lows, officially acknowledge those as the bear market lows. I think there's overwhelming technical evidence that supports we're in a bull market, and not just that 20% qualifier. Off those lows, we're in an uptrend. The moving averages confirm that. Momentum confirms that. But speaking of momentum, we're looking a little bit overbought here in June, and that's really where our call is that we're going to see a breather here for this relatively new bull market. Part of that call is based on the technology sector. That's really where we're seeing overbought conditions broad-based. And if you think about technology, that's really been the main driver of this year's rally. If you strip out the tech sector, the S&P 500 is up about 5% year to date. So there's some pretty big shoes to fill for other sectors if we get a pause in technology. If you look at the technical setup for the technology sector, it's well extended above its moving average, actually hit a 13% premium above its 50-day moving average. Now, that's a 2 standard deviation move. We like to look at that as kind of a rubber band. As it gets stretched too far, you often get at least a pause or a potential pullback. So we think that could spill over into the S&P 500. Now, to end on a good note, the positive sign when you get a mean reversion in a bull market, you usually come back to the longer term uptrend. The S&P 500, we think worst case scenario, that could be right around the 200-day moving average.
So we're going to break some of that down because, as you mentioned there, if we do have this breather, then which are some of the sectors you think are really primed to try and at least fill some of those shoes if tech it does start to pull back a little bit?
Yeah, so we really like the industrial sector. Technically, it looks constructive, and thematically, when you look technically, we'll start there. It recently bounced off its 200-day moving average, broke out of this consolidation range that it's been stuck in for most of the year. So it hasn't really participated in this rally except for the last few weeks. So we're seeing the sector broaden out, get back toward record high territory, and also relative strength. When you compare it to the S&P 500, that's actually reasserting itself into an uptrend. And again, breadth is expanding there. We're seeing a lot of new 52-week highs within that industrial sector. Big part of that, I think, is going to be this reshoring theme that we continue to hear about, especially among CEOs. It was actually one of the most mentioned, the reshoring tagline was one of the most mentioned things in the Q1 earnings call, even more than AI, according to some reports. So I think that fund flows will continue to move into the industrial sector. From a valuation standpoint, it looks relatively cheap relative to its own history. So we continue to like that on the as a potential area where capital could flow out of tech and into the industrial sector.
So let's talk inflection points here, because you noted the cumulative S&P 500 advanced decline. You're saying that that's at an important inflection point. Break that down for us and what historically has tended to happen when we see this.
Yeah, so the advanced decline line, or the cumulative advanced decline line for the S&P 500, simply just measures the number of advancing stocks versus the number of declining stocks. When it's moving higher, that means there's more advancers than decliners. And we like to use this as a measure of market breadth to confirm or deviate from an actual breakout point. And that advanced decline line is basically stalled right at the August highs. So we're waiting for confirmation there to see if it breaks out. That would give additional validation to the S&P 500's breakout above 4,300. We have not seen that inflection point yet, so we're potentially seeing a divergence here with the S&P 500 moving higher and that advanced decline line failing to confirm that recent breakout.
And of course, we have a number of factors at play. You have a lot of people pouring in because of this AI fervor, but you also have the Fed, at least in pause or skip mode, still expecting 2 more rate hikes by the end of the year. So then when you factor in the fact that markets are essentially either ignoring it or looking past some of those warnings from the Fed, how do you position your portfolio?
Yeah, so we're actually overweight toward fixed income right now and an up in quality approach. We think it's time for investors to lock in some of these high yields, especially how inverted the yield curve is right now. You know, you can get money market funds that are 5%, but there's reinvestment risk there. So we're actually recommending shorter duration, high quality corporates, locking in some of those rates right now for our clients.
I appreciate you taking the time this morning. Adam Turnquist there, LPL Financial Chief Technical Strategist. Thank you for joining me this morning.
Thank you.
All right, well, I'm watching shares of Moderna this morning. The stock rising after receiving some love from UBS. The firm upgrading the vaccine maker to buy from neutral, but cutting its price target to $191 from $221. Now, the analysts acknowledged that uncertainty around the COVID market will impact revenue for 2023, but said investors don't appreciate the other vaccines in Moderna's pipeline outside of COVID, citing the shots for the flu, RSV, and more. Now, the company just last week sought FDA approval for another COVID vaccine. Still, Moderna stock is off significantly from its pandemic highs. Well, more COVID coverage coming up ahead. What newly declassified documents tell us about the pandemic's origins. Our own Anjali Kemlani breaks that down for us. You won't want to miss it. The last month has been good to travel stocks, with the likes of Delta, Norwegian Cruise Lines and Carnival on the up ahead of the summer season. Delta, to take one example, is coming off its longest winning streak ever. Shifting gears, looking at cruise operators, they've also been going strong, but expectations for higher rates in the month ahead could be bad news for investors in this space. And while taking a look at Carnival shares, they're slumping this morning. However, even after reporting second quarter earnings above expectations, the cruise operator saw a jump in demand, reaching an all-time high for quarterly bookings. Joining us now, James Hardiman, City Leisure and Travel Analyst. Thank you so much for joining me this morning. I mean, when you look at Carnival's data here, top and bottom line beat, demand and sales better than expected, but investors seem to be really honing on some of these other costs in terms of labor and marketing. Do you think it should be selling off this much at this point?
It's not all that surprising to me. I do think they're to some degree a victim of their own success, right? A lot of people got on board with this story. I mean, we upgraded a month ago, and the stock was up 50%. As I talked to investors over the last week or two, it really felt like expectations had gotten ahead of themselves. We were hearing some pretty unreasonable whisper numbers in terms of the profitability for the current quarter. But at the end of the day, I mean, if you had showed me these results 3 months ago, I think everybody would be doing backflips. I think expectations got ahead of themselves. And then to your point, some of the cost takeaways here were, I wouldn't even call them concerning, but surprising for sure. And so at the end of the day, they beat on the strength of really strong demand, really strong pricing. But there were some offsets from a cost perspective that we're going to have to work through over the remainder of the year.
And we did see some other cruise operators, Royal Caribbean and Norwegian, also taking a hit after that earnings data came out. But how much pricing power do you think Carnival has over its rivals here?
Well, I mean, our call is that the entire group has significant pricing power relative to other forms of travel and entertainment, right? I mean, the math that we do suggests that the cruise industry as a whole, ticket prices are up sort of low to mid single digits versus 2019. There aren't a whole lot of consumer sectors that can say the same thing. Most notably, when you compare the cruise sector to land-based vacations, we used to be talking about a 20 to 30% discount to that form of entertainment. We're now looking at more like 40 to 50%. And so I think as consumers become more discerning, try to pinch pennies a little bit, I think cruise by comparison will look like a really good bargain.
So then why do you think that cruises are able to do much better then versus, I mean, obviously consumers have a lot of choices about how they spend their money on travel. Why cruises versus, say, other forms of travel?
Yeah, I mean, I think a lot of it is just that they sat out the last couple years of unprecedented inflation, right? These ships were just trying to get back onto the water. This is the industry that was probably the hardest hit from the pandemic. And so a lot of it is just reversion to normality, which I think is going to help them from a pricing perspective. And then the other piece is I think they've added significant assets to the offering in recent years. Particularly, we talked about land-based vacations. Pretty much all these companies that now have major sort of land-based islands, effectively, where you take the cruise, you spend a day at a big resort island that's specifically for cruise customers, and I think customers are really eating that up. That is, I think, a more effective asset than it's ever been.
A lot of people wondering then, what is actually propping up demand at this point? Because at first, when people started to travel, it was, it's pent up demand. It's been a while now, but you also have, a consumer that's trying to tighten purse strings. Why do you think we're still seeing this sort of demand here?
Yeah, it's a great question. I'd say early in the restart for cruise, it was all about that pent up demand piece. There were some estimates out there that maybe 50 million vacations had been canceled or deferred, and so much of that initial business came from people that had been longtime cruisers and were looking to get back on. I think what we've seen over the last quarter or two is that new to cruise segment that Carnival just finished talking about, the fact that it is back to, and in a lot of instances ahead of where it was in 2019. So that group, right, young millennial families that are looking to see the world on a budget, are really beginning to step up and into the cruise space.
And James, I want to get your predictions for what we might see with the 4th of July travel weekend. I mean, AAA predicting record-breaking travel volumes by car and air. About 50.7 million Americans will travel 50 miles or more. 4.17 million Americans will fly. So some record-breaking numbers here. Are you seeing those sort of numbers as well? And what does that mean in terms of spending?
It's a great question, and I think it's an open question at this point. I think we have difficult comparisons. If we rewind back to last summer, I do think there was a lot of that revenge spending that was taking place, and I think most of that has worked its way through the system. Depending on what we're talking about here, as I talk about cruise travel, I make the point that a recession would be an improvement for cruise, right? They're coming from a really dark place. Conversely, one of the other verticals that I follow in the theme park space, the numbers that we've seen have been lackluster, to put it mildly. And so the outlook there is, I think, a little bit more troubling. Weather always plays a big role. So a lot of this is going to depend on sort of what sort of weather we see over the next week or so. But certainly that outlook a little bit more troubling.
At least for now, cruise is steaming ahead, playing catch up after, as you mentioned, being on the back foot due to the pandemic. A big thank you for joining me this morning. James Hardiman, City Leisure and Travel Analyst. Thank you so much.
Thanks for having me.
All right, coming up, new details arise on the origins of COVID-19. Our own Anjali Kemlani has the details on that story next. Taking a look at oil prices hovering below $70 a barrel today. That's after the aborted coup in Russia added to concerns surrounding geopolitical risks. Now, this comes as the OPEC group of oil producers expects global demand to rise to 110 million barrels per day by 2045. Joining us now is Yahoo Finance's Ines Ferre to give us the details. Hey, Ines.
Hey, Rochelle, that's right. And we are taking a look right now at oil prices. Pretty muted right now. We had seen WTI surge higher earlier, and that has now pared down those gains with WTI futures just down about 0.1%, and Brent crude relatively flat right now. Now, I was able to reach out to Andy Lippo of Lippo Oil Associates to get his thoughts on what happened over the weekend in Russia and what this could mean for the oil markets. He basically said that you can look at this this in two ways. Basically, if what happened in Russia, which appears to be short-lived, if this does lead to a civil war, if this is the beginning of the end for Vladimir Putin, then you can expect to see perhaps different areas of Russia wanting to control more of their natural resources, wanting to control more of their pipelines. So you could see a disruption when it comes to the oil markets or oil coming out of Russia. Although there is a contrarian view, which is that if Vladimir Putin continues with his strategy, then he will want to keep funding the war in Ukraine. He will want to also fund his supporters. So you could see more supply of oil coming into the market, and this would be bearish for the oil markets. Of course, the developments in Russia have been really closely watched because we did see what happened with WTI and with Brent crude after the Ukraine war broke out last year. And you can see the price action where you saw WTI hitting $120 a barrel. You saw Brent crude hitting $130 a barrel. Right now, we're looking at WTI just shy of $70 a barrel and Brent at $74 a barrel. The demand coming out of China with its recovery has been lackluster. The data pointing there has not been great. You are seeing commodities, according to one analyst that spoke on Yahoo Finance earlier this morning from Bloomberg Intelligence, basically saying that commodities are in a bear market. And there's not really anything that's going to change that right now because the Fed is continuing with its tighter monetary policy. Rochelle?
So then with so many factors at play, then what does this mean for OPEC's outlook for 2045?
Yeah, so OPEC has come out with its outlook for demand going forward with oil, with the Secretary General of OPEC saying that they're going to see demand rising by 110 million barrels per day by 2045. That's a 23% increase from the current level. And that differs with what the IEA, the International Energy Agency, has said, because the IEA is seeing a slowdown when it comes to demand going forward. And that is because of the transition into electric vehicles, into green energy. Now, what the two do seem to agree on is that Asia is going to really be the catalyst for demand going forward. That would be China, that would be India. But nevertheless, a real divergence when it comes to that. And there is a school of thought that, look, to get to the green energy, you will need to have fossil fuels. You will need more energy in order to get there, in order to produce all the electric vehicles that you want to make, et cetera. But then, of course, the other sort of thesis is that this will eventually lower demand for oil going forward.
Yeah, because those numbers for the oil demand predictions, they're very lofty there, but we'll see what happens. Obviously, a long way till 2045. Thank you for getting us up to speed. Our very own Ines Ferre.
Thank you.
Well, a newly declassified report from the United States Office of the Director of National Intelligence shows that high-ups in the government remain unsure about the origins of the coronavirus. Joining us now with more details is Yahoo Finance's Anjali Khemlani. Anjali, what's the latest?
That's right, Rochelle. So we got finally a peek at the declassified version of the report from the intelligence community, really looking at two theories that have been prominent in the origins of COVID. The first, of course, being the natural animal spillover, as scientists have concluded from what happened, making the Wuhan animal market the epicenter, as well as the lab leak theory, the idea that one of the institutes in Wuhan were basically ground zero for this. And so the intelligence community has looked at this and has been kind of split over it. So what this report told us is that both of those theories are still in play, according to the intelligence community. There were some reports of potentially sick researchers in the fall of 2019 in Wuhan, potentially having COVID symptoms. This has debunked that, essentially saying that there was no proof, at least found that they had any symptoms synonymous with COVID. It also looks at what kind of coronaviruses were being studied at the time in the lab. There's suggestions that gain of function research was being done on SARS-CoV-2, but there's no proof that that existed in these labs. And the only thing that really came out were some safety concerns when there was an inspection in 2020. Now, the report makes note specifically that it does not address the origins of the report and the hypotheses, just looking at the one Wuhan Institute. So it does preclude any other sources. It didn't look at the market, for example, and that all the intelligence agencies, so all these different agencies that are part of the community, are still looking at what caused it. And this is just based on intelligence reports. So if you take a look at the breakdown, we knew a little bit earlier than this report that the different agencies had different suggestions on what it could be. The Department of Energy and the FBI, for example, having some attention to the lab leak theory, while a lot of other agencies looked at, for example, the animal spillover idea, including the World Health Organization, on that bandwagon. And so this really sets up an ongoing look. At least we have this view of the report as a result of President Joe Biden signing into law the declassification after Representative Josh Hawley, passed this bill. So it's the first view. It's a first sort of understanding layer of what we're looking into for this pandemic.
And we know that social media always has a field day with any sort of data that's speaking about COVID origins. But what are the experts saying about this report?
Well, I'm glad you asked, because the experts are kind of annoyed that this is still an intelligence report and that a lot of the focus has been on what the intelligence community can ascertain. Really, the idea that, there's a lot of geopolitical factors at play, not trusting China being one of them. So I did speak to one of our favorite virologists on the show, Dr. Angie Rasmussen, and she told me that the biggest issue is that it suggests the origin of the pandemic or intelligence or political matter when it's really a scientific one, and the evidence base supports the latter. And that includes the samples collected from the Wuhan market. We never got those samples from the animals themselves, which is sort of a break in the link of genetic sequencing, but at least the market samples are still being studied. And so those are where we should be looking for those answers.
Certainly continues to be a political football everywhere you look on social media. Thank you so much for getting us up to speed, Anjali Kemlani there. All right, now to Glastonbury. The big UK music festival took place this past weekend. It drew in crowds of more than 200,000 people. And this follows the massive success of Taylor Swift's Eras Tour, which has drawn in thousands of Swifties and drove up ticket prices to over $1,000 at the tour's peak. And then, of course, Beyoncé's Renaissance Tour has also shown record numbers of attendees as well. According to data compiled by Statista, the music event industry, which includes festivals, concerts, musicals, and operas, is expected to have finally gotten over its COVID slump. Music-related events are predicted to reach $33.8 billion this year. That's actually up 65% from 2022 and 49% from 2019. All right, coming up, how Americans can meet their 2023 savings goals. I'll speak to an expert for some top tips next. Generative AI, it's the buzzword of 2023, and it's safe to say artificial intelligence has become a growing force for businesses. Take NVIDIA, for example. AI has turned out to be a huge catalyst for the company. Its stock up almost 188% year to date. NVIDIA CEO Jensen Huang is speaking at Snowflake's developer conference today to discuss the biggest trends in generative AI and accelerated computing. Now, AI talks are also expected to be in the spotlight at Toronto's Collision Conference, kicking off this Monday afternoon. Yahoo Finance's Ali Garfinkel got things started early, talking to GitHub CEO Thomas Dohmke about the economic impact of AI. Hey, Ali.
Hi, Rochelle. I am coming to you from a hotel in downtown Toronto. I just did my interview with Dohmke. I walked downstairs to this cafe and sat down with you. And Dohmke's primary message to me was really clear. And it's that he believes generative AI will improve productivity. And he knows this because he's seeing it in the developer community that GitHub works with every day. Now, GitHub was an early mover in generative AI, and they've been working with OpenAI on a specific chatbot for GitHub called GitHub Copilot for 3 years. Now, this Microsoft subsidiary has been conducting studies all of its own, trying to assess what the economic impact of AI will really be. And they came up with some pretty incredible statistics. For instance, developers using GitHub Copilot are 55.8% faster than the control group who is not using Copilot, which is the generative AI tool. And they've estimated that these productivity gains could boost global GDP by 1.5 trillion by 2030. And the most striking thing to me is that Dohmke was making the case that this is actually a pretty conservative estimate. Tech often grows exponentially, and this could be the sort of thing where we're seeing applications in the next 2-3 years even that really boost some of these productivity gains that they're already seeing at GitHub. Now, fundamentally, Dohmke is really optimistic, I would say, about the economic impact of AI, but he doesn't believe, for example, that coding jobs are going to be taken en masse, because the reality is the best code and the best ideas are still going to be conducted by humans. What he fundamentally said was this: AI right now is a probability machine, and it can do a great job to a point.
And that's definitely worth keeping in mind. Thank you for keeping your ear to the ground there. Looking forward to all your coverage coming out of there. Our very own Ali Garfinkel. Well, it's never too early to start saving for retirement. With sky-high inflation, the anticipation of additional interest rate hikes, and fears of a potential U.S. recession, investors are continuing to seek out the best practices to keep their portfolios protected. Well, now Vanguard's annual report, How America Saves, compiled the saving behaviors of nearly 5 million defined contribution plan participants across Vanguard's business last year. And despite all the uncertainty in this tough economic climate, retirement savers are staying the course. The data highlights that Americans generally remained resilient. For a deeper dive into the report, we're joined by Joel Dixon, Vanguard Global Head of Advice Methodology. Thank you for joining me this morning, Joel. So, how surprised are you at how resilient savers have been despite everything going on with the macro environment?
Well, thank you, Rochelle, for having me today. I don't know that it's actually that surprising. This is the continuation of a trend, this concept of resilience that we've seen in the retirement plan market over the last 10 to 15 years. But that in many ways had been during more advantageous market environments. The last year, as you mentioned, much more challenging, high inflation, market volatility and uncertainty. Yet that concept of resilience really does still come out, and if anything, even improved during 2022. You see that in savings rates. For example, more than 25% of plan participants were contributing more than 10% of their income to their long-term retirement savings. And we saw a record high average deferral rate of nearly 7.5% last year.
So then what have been the most effective ways that you've seen people growing their savings over the past year?
Really, the main effective change over the last 10 years or so has been the real growth of automatic investment programs and approaches in the workplace retirement plan area. The auto enrollment, auto escalation of savings, and the use of single investment solutions to do that automatic investing, so-called target date funds are a common example of this, have really allowed very broad access to low cost, well diversified, suitable asset allocation portfolios for plan participants. And the fact now that roughly 3/4 of plans that have more than 1,000 participants in them offer these automatic savings features is really a testament to that growth. And you see it in different ways that show good behavior on the part of participants. Increased savings rates, increased plan participation rates, and also lower transactions being done by participants in response to market volatility or market events.
So for people who are wondering if they would do better going with a professionally managed account versus AI or trying to do it themselves, what sort of returns are people seeing when you stack them up together?
Well, it's interesting. We are seeing a definite sort of, if you will, the next growth area in the retirement plan space in many ways in terms of plan designs and plan options is this concept of low cost personalized advice to really allow those that may not have the time, the willingness, or the ability to manage their long-term portfolios to meet their goals, to do this in a more automated way. And in fact, we are seeing that growth in retirement plan offerings from an advice standpoint, where now a much larger percentage of plan participants have access to low-cost advice. About 2/3 or so are turning to professionals for meeting their long-term needs in terms of their savings and investing strategies. And being able to do this directly through a retirement plan option is in many ways that next way of really boosting potentially investors' long-term outcomes within the retirement plan design and landscape.
And it does make more sense as we do seem to be getting into a phase of a lot more nuance in this economy than we were sort of obviously pre-COVID. I do want to ask you though, for your top tips to establish and stick with your saving goals, especially when you look at the high amount of debt people have, you're sort of trying to figure out, should I be saving? Should I be paying off the debt? What are your top tips for really growing your savings?
So, first of all, I think that the most important thing is we all love to talk about and follow kind of the markets and the economy and so forth. And as you said, Rochelle, there's a lot of nuance, if you will, in that these days. But over time, your long-term success as an investor to meet your, for example, retirement goals are really in many ways totally under your own control through your own actions. By saving enough, by minimizing your costs, both taxes and investment costs and transaction costs along the way, by making sure you have a low cost, diversified, suitable investment mix for your long-term goals, and then sticking to that plan over time. Those things will allow that long-term success in many different market environments and economic situations. I guess I would say that, in the case of people that are trying to manage debt versus, investing and saving in a retirement plan, a couple of real high-level tips. First of all, take full advantage of any employer match that you may be able to, and then think about paying off your really high interest rate debt and not reestablishing that. And by the way, I think it's important, paying off debt is a form of saving. So, all of this opens up your future long-term savings capacity. And then you probably do need to think about also, how do you weather potential future economic conditions or storms that may occur on the horizon through things like having a rainy day fund at your disposal should the need arise.
I do appreciate those tips. I know a lot of people could always use them. A big thank you there to Joel Dixon, Vanguard Global Head of Advice Methodology. Thank you for your time this morning.
Thank you very much.
All right, coming up, we'll be talking with the founder and CIO of Spear Invest on the new bubble in the tech sector. Stay with us. Spear Alpha is an ETF listed on the Nasdaq. The company behind it, Spear Invest, is an asset manager specializing in positioning investors throughout the industrial technology sector. They think that while consumer tech drove the past tech cycle, business-to-business technology will drive the new bubble in the space. We're joined now by Spear Invest founder and CIO Ivana Delevska to discuss more on this. Good to see you, Ivana. So talk about how this is going to play out in terms of business-to-business and tech.
Well, thanks for having me, Rochelle. So what we saw over the past 10 years or since the dot-com bubble is the real winners being in the consumer technology sector. So this is really the first area that technology made a transformational change. So this would be areas like streaming, social media, etc. We expect as we look forward, especially with the advancements in AI, B2B technology is going to be a much wider market. So this would impact traditional industries from machinery, industrials, life sciences, basically every industry you can think of where there has not been enough technology embedded is going to be transformed by what we're seeing in the latest innovations and trends.
So let's break down some of those sectors, because even within AI, obviously every company and its mother is coming out with some sort of AI product or service. How do you determine which are the ones that are really worth pursuing?
Well, Rochelle, we have an active product that's really based on fundamental research. So we really dig deep inside of the value chain to understand who is providing what services, who is well positioned. So as we look into AI, there is definitely a buzz affecting every company that has anything to do with AI. And what we do here is parse out which ones do we think are going to be the long-term winners versus are just hype. And here I'll point to a few areas down the supply chain or value chain that we don't hear a lot of investors talk about. We all know about the hardware side. So this would be companies like NVIDIA, AMD. Those are going to be the obvious place. And we do think there is fundamental support even here behind those. But if you look deeper, AI is really a data problem. And we believe that data infrastructure, cloud infrastructure is going to be a big beneficiary of AI going forward. And these companies are still trading at very depressed valuations because of the optimization that we've seen in cloud spend caused by the recession.
And we know that with the rise of AI, we're also seeing more of a push in cybersecurity. What are some of the names that you think people should be paying some attention to there?
That's right, Rochelle. So it's going to be very interesting to see, as you see more AI workloads, you're going to see also more AI threats. And the interesting thing in cybersecurity is that over the past 5 years, we've developed some pretty solid AI-based cyber threat solutions. So what this means, though, is that now the threats are going to become AI-based, and you're going to need constantly improving products and solutions. As we have more data, processes are different. The way you do analyze the data, the way you process the data is going to be different. So you're going to need a whole new set of cyber solutions. And we believe the cyber cycle is just at early innings of development here.
And for some people who are sort of looking at some of the valuations in the tech space here, how does that compare with some of the ones that you're following in the B2B space that people should be looking at?
Well, Rochelle, B2B tech will be a subset of broader technology. And I can speak to broader technology trends. Basically, what we've seen in B2B software, for example, valuations were as high as 20 times EV to revenue at the peak of the cycle, right? So 2 years ago, you had companies trading at 20 times EV to next 12-month revenue. Now, those valuations reset lower to 5 times at the bottom. So what we've seen over the past 6 months is a slight uptick to 6 times. So while it seems like the moves are large, they're really off of very depressed levels. So valuations here are still attractive. However, we don't believe the next leg up will be driven by valuations. We think here valuations are going to stabilize, and the next leg up will really be driven by earnings inflection.
So then how do you play that out when you have the Fed in a pause and skip mode at the moment, and you're trying to parse out, what you should be looking at for perhaps the next 6 months?
So we are really looking at companies that are going to have earnings acceleration. The first one will be semiconductors, right? Those are early cycle, And we see the inflection as early as 2Q of this year. So companies like NVIDIA, for example, that are particularly well positioned, they were able to post some really outstanding results, basically increasing guidance 50% above consensus and analyst estimates raising 40+% in the out years. So we are really seeing this early cycle then translate into later cycle areas like cloud spending, like cybersecurity. Because basically, once you get the chip, what are you going to do with it, right? So these hyperscalers are investing in this hardware infrastructure, but then they're going to be selling these services to third parties. And we think that's going to drive the next earnings cycle and earnings boom.
And as people sort of await this inflection point, for people who are new to getting into B2B tech, what are some of the risks that you're also being mindful of?
So there is always risk in technology, right? It's a pretty volatile space. There is some interest rate risk going forward. If rates increase, for example, from 4% for the 10-year to 6+%, you will see valuations kind of put a ceiling on the earnings upside trajectory. There is also a lot of times the main risk here is not doing proper analysis and not really understanding what companies are in the benefiting from breakthrough trends and what companies are actually could become obsolete. So we see when they're in times where there is a big technology change like this generative AI, we see it creating a big set of winners, but also a big set of losers. And you don't want to be with the losers.
Indeed. Well, thank you so much to Spear Invest founder and CIO Ivana Delevska. Thank you for joining me this morning. All right, we're keeping our eyes on Uber this morning. The peer-to-peer ride-sharing company is trending up. Bernstein analysts came out with a note on the company, reaffirming it as a top pick, maintaining its rating at outperform. The firm also raised its price target to $50, arguing that Uber is, quote, delivering on its promises in profitability, capital discipline, and growth. Bernstein analysts projected that Uber's free cash flow will go into nearly $6 billion from $2 billion by 2025, saying that Uber has the most compelling free cash flow growth stories over the next 2 to 3 years. We'll be keeping an eye on that one for you. Right, well, before we go, let's do a final check of the markets here. Still looking at a mixed picture, though. Now the S&P has dipped into negative territory. Still just the Dow in positive territory, and ever so slightly, just up by about a point. Taking a look at the S&P 500, they're down about 3 points, still relatively flat here. As you can see now, all of them now in negative territory. The Nasdaq also down about 1/3%, or about 36 points. Still trading in that narrow range, sort of pulling back as we await a lot of economic data points that are going to be coming out this week. Well, that does it for now. I'm Rochelle Akutho, but I'll be back with you at 11 a.m. Eastern. Yahoo Finance will be back live with you at 3 p.m. Eastern. We'll see you then.